increases will follow. Several developments in the crisis in Ukraine. The United Nations Security Council will debate the issue today, and the Pentagon says that Moscow has increased the number of troops that have been deployed along the Ukrainian border. Russia's President Vladimir Putin has no plans to launch an invasion. Bloomberg's learned that Elliott Investment Management and Vista Equity are nearing a deal to buy software maker Citrix Systems. The agreement would value the company's equity at about $13 billion. Citrix makes software that workers use to log onto their corporate programs virtually. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project. Initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
What we're seeing, though, is, as expected, as this virus moves through the population, if it picks up a mutation that makes it a little bit better to infect or makes it a little bit more easier to infect vaccinated people, that virus will become the dominant virus eventually. We're seeing some of the fallout from those huge numbers of cases in terms of new variants emerging and starting to spread.
Andy Pekosh there of Johns Hopkins Bloomberg School of Public Health. From New York City with Tom Keene and Lisa Bramberts, I'm Jonathan Ferro. Your equity market to close out January. This morning at least is down 0.2% on S&P 500 futures. NASDAQ futures up a third, up about 47 points. Yields higher on 10s in the US, up 8 basis points to 178.38 in Germany, up 4 basis points. Flirting with zero, very briefly into positive territory earlier, negative about a basis point right now. Going into the ECB this coming Thursday, Tom. Big challenge for President Lagarde. Why is the ECB in the Eurozone different to what we're experiencing here in the US?
What do we expect, John? Game that for us. There's no way she can frame a Powell kind of tone.
No way. No way. No one's expecting that. The conversation is, can they sit out the start of this rate hiking cycle of the Federal Reserve as they tee up 3, 4, maybe 5, maybe 7, if you're Ethan Harris over at Bank of America. TK, the conversation of the ECB is whether they hike at all at the back end of this year. Maybe it gets pushed out to next year. We did a survey last week of economists here at Bloomberg, Tom. Our survey of economists had it at 18 months out, middle of next year, for the first move from the ECB.
And that'll change off currency, Euro 111.57. I also look at Euro Swissy, which has been weak Swiss here. A little bit better news, perhaps, on Ukraine. Right now, Joshua Sharfstein with us, Vice Dean of Johns Hopkins Bloomberg School of Public Health. Of course, Michael Bloomberg, a nodding acquaintance with his television and radio property as well. Dr. Sharfstein, it is good news, whether it is the thousands assembled in Los Angeles and Kansas City for football, or in the walk-up I live in the lobby, everybody has to wear a mask. There seem to be great polarities. Here's the reality. We see cases rolling over nicely. We see hospitalizations rolling over somewhat. We're waiting for deaths to roll over. When deaths roll over, how will public policy change?
Well, I think public policy is changing in places where the cases are coming down and the hospitalizations are coming down now. So I think it's going to be a regional phenomenon. And then I think, to your point, I think the national mood will really start to change as deaths come much further down. And this is approaching the moment, where we are going to see COVID start to fade a little bit more into the background. I don't think we'll have nearly as much disruption in our lives in 2022, barring the emergence of something that we haven't anticipated, which of course could still happen.
The vaccine rate, I'm going to call amateur and Omicron, from 60 or 61 out to 64%. How critical is it to double that out to a 68% statistic?
Sorry, that is what statistic?
The vaccine rate was 61%. It's now 64%, according to most of the media reports I see. How critical is it to double that out to 68%? Does that mean something?
With every increase in vaccination, we're going to get fewer hospitalizations and fewer deaths. The value of vaccination again proved itself during the Omicron wave. So we have tools to protect ourselves, and we have to keep going. So just because it's going to fade into the background in our lives, the more we are smart about, protecting ourselves, preparing, the more it'll fade into our lives. It's not just by ignoring it altogether that we get that benefit.
Dr. Sharfstein, meanwhile, that's the U.S. and that's Europe, perhaps. Over in China, they've been trying to pursue a zero COVID policy. And we do have the Olympics starting on Friday. Hong Kong is experiencing a pretty big upsurge in Omicron. And one professor at the University of Hong Kong who has researched Omicron said the horse has bolted, and I don't think that the government is going to be able to get on top of this. What's the trajectory of COVID cases that you expect over in China, given the lack of social immunity built up by natural infection and just a normal life?
Well, it's the lack of immunity in part because the vaccines they've used have not been the strongest vaccines. And so they are vulnerable to COVID. There's no question about it. This virus and some of the Omicron variants we're seeing are crazy contagious. So that's not a situation that's very good. And the idea of persisting in zero COVID without the benefit of better vaccines is a real challenge for China. And, I don't know. It's hard to believe that they could make it through with so many people coming in without it getting out. Of course, they have tools and approaches that we would find unacceptable in this country to accomplish that. So I don't know what's going to happen.
Those tools that we would consider unacceptable, are they even enough, though, to stave off the upsurge in likely Omicron cases and likely COVID cases after the Olympics? Can you game out what it might look like in the weeks following?
Well, if the Omicron gets out into the Chinese population, it's likely to spread very quickly, given the fact that the vaccines used there are not as effective. And then we'll have to see the scale of the reaction from the Chinese authorities. I don't know what's going to happen. I'm not someone who's going to be able to put together a scenario between the biology and the politics, but I don't think it's going to be, very pleasant for people in China if they go for a zero COVID approach in the setting of such an incredibly infectious variant. So, on the other hand, they may, have to do some pretty significant actions to avoid so many people getting very sick.
Lisa, are you surprised these Olympics are happening?
From every point of view. I love the fact that Vladimir Putin is going to be going and helping with the inauguration of this Olympics, just giving you a sense of it. But honestly, John, I don't understand how they can pursue a zero COVID policy while having individuals from all around the world come into their borders and basically celebrate an international kind of confab. It doesn't make sense to me.
We'll see how this plays out. Good luck to them. Dr. Joshua Sharfstein there of the Johns Hopkins Bloomberg School of Public Health. Thank you, sir. Looking ahead through the week, just a ton of economic data stateside. The ISM, ADP, non-farm payrolls to close out the week. What have we got in between, Tom? Jolts, PMIs, take your pick.
Yeah, so Tom, but John, you're the one who was out front on ISM. Explain to our audience on radio and television the importance of ISM, that first look.
And I think above 50 is expansion. To see it in the high 50s still, it's really decent. It's really, really good. What we want to see is the prices paid component keep coming down. And when you look inside the industry commentary, Tom, you want to hear from a selected group of industries, each sector, talking about those supply chains getting better and not worse. That's the kind of feedback you're looking for in this.
I heard that in the weekend research, John, that there's some constructive tone on inflation right now.
Lisa, that's the hope. That's the hope that things get better.
Hope is the right word.
Well, I was really struck by Seth Carpenter of Morgan Stanley talking about the lack of understanding in the economics profession of what the inflationary impulse really is. Is it labor market tightness? Is it the potential for supply chain disruptions? And frankly, what happens when they last for longer than people expect and it bleeds into expectations?
It is the most educated guessing game on the planet. All of it is. All of it is. Let's be clear about that. It always is. Futures down 0.2 on the S&P. On the NASDAQ, up 0.4%. Yields are higher by a single basis point on 10s to 178.38. And crude back with a lift to 87.12. From New York City, for our audience worldwide, this is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done, uses a small sample number, and most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
What's important here is how the investor risk appetite has been.
Earnings will start to matter more because that's going to be the key to driving markets higher.
There is a risk to growth, especially in the second half of the year.
Financial conditions haven't really tightened enough, clearly.
I think it's a bumpy ride.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
What did Russell Crowe say, Lisa? Are you not entertained? Can you do that accent? I bet you Tom can.
I'm sure he can.
Do it another time, TK. From New York City, good morning to you all with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures down 7 on the S&P, negative a little more than 0.1%. Tom Keene, this morning, it's quiet. This month, anything but.
Anything but. You wonder what February will be. Russell Crowe celebrating Ash Barty winning the Australia Open, no doubt. And, John, it's what we're going to see here about who wins. What I love here, John, is the battle. You've outlined the parlor game of rate increases and all that devolving back to economic growth. Well, how do we know? We know we're going to be Friday or next Monday with a lot more data under our belt.
And as far as that data is concerned, Tom, on this Friday, we're expecting it to be softer on payrolls. You may even have a negative number. Will that change the rate hike conversation? Will it change it in any way, shape, or form?
It's going to be asterisk by Omicron. There's no question about it. Omicron's going to play into all this data. What I would suggest, John, is you see 2% GDP maybe as something for Q1. How do we frame the second quarter GDP? We're not there yet, but maybe we begin to see that exactly 1 week from now.
Elisa, as the new consensus on the street becomes 5 hikes.
Yeah, 5 hikes right now. And really the question is this as good as it gets? I mean, if you want to quote Russell Crowe, I'm going to quote Jack Nicholson. But at a certain point, are we going to get better growth ahead, or just than we've seen over the past decade? Or is this kind of the peak? And is the inflation going to decelerate growth in a way that could potentially be problematic? And that, I think, is what you're seeing the suggestions of in the yield curve.
That's what's fascinating about the Steve Englander call over at Standard Chartered. We'll get into the Treasury calls a little bit later this morning that come from Stan Chart. But Tom, a more definitive slowing as the year progresses. Slowing not just of inflation, but of growth through the back end of this year. That's the Standard Chartered call.
And at the bottom of his note from last week, he talks about a risk rally. And, you know, after what we saw on Friday, and I'm not in any way predicting the market, but, John, we begin February, essentially this Monday, with a 28.80 VIX. There's some angst out there, but nothing like what we saw a week ago.
If you're long the NASDAQ, you're hoping for more of the same from this morning. up another 0.4% on the Nasdaq, up 57 as Tom points out. Earnings. Amazon a little bit later this week. The S&P 500 down 0.2%. We are negative at 9 points there on the day. We're down just a bit on the month. We're down 7%. In the bond market, yields are higher at the front and the back end, up 2 basis points on 10 to Lisa, 178.56.
Yeah, really the question is this going to be a front-loaded Federal Reserve? Is a 50 basis point rate hike at the March meeting completely off the table? At 11:30 a.m., perhaps San Francisco Fed President Mary Daly will talk about it. She's having an interview with Reuters Live. This, of course, goes to the Raphael Bostic quote in the Financial Times over the weekend. The Atlanta Fed President coming out and saying, if the data say things have evolved in a way that a 50 basis point move is required or be appropriate, then I'm going to lean into that. If moving in successive meetings makes sense, I'll be comfortable with that. John, you pointed out this does not mean that he supports a 50 basis point hike, but it means that it's not off the table. Okay, maybe a 100 basis point hike is not off the table, but really the issue is, do they see a problematic amount of inflation that they want to get ahead of, and do they suggest with their moves that that is what they're doing? Then today what you get is the U.S. Census Bureau coming out with a report about the incomes of older Americans. The reason why this is interesting to me is because you've seen the participation rate stay very low for those age 55 and older in the United States, basically retiring. They've made a lot of money in the stock market. It's not a great job market, and frankly, a lot of people are worried. It is a great job market, but not necessarily for the jobs that they're going to want to do, especially if there is a problem with respect to COVID. So how much do we see any information on that? And at 2 p.m., Qatar's Emir will visit President Biden to discuss supplying Europe with more liquefied natural gas, among others. How much can the U.S. get support from other nations to help support Europe in the case that the conflagration between Ukraine and Russia continues to get worse? And you've seen Brent crude rise to the highest levels in 7 years, through $90, surging the most this month. I mean, I was looking at the returns this month, John. More than 16% you've seen that climb in Brent crude.
Unbelievable, the moves for both Brent and WTI in a single month. Can we nail down the Bramo call on Fed hikes? Is it 100 basis points now for March, Lisa?
Anything's on the table, I'll just say that. Honestly, what seems likely is a 25 basis point hike. It seems unlikely they'd go 50 basis points, but what they say about the balance sheet, what they say about the parameters that would push them to hike more really is where my focus is.
A lot's changed in a single month, that's for sure. Lisa, thank you. Joining us now, Sarah Hunt, Portfolio Manager at Alpine Woods Capital Investors. Sarah, can we just start here? You're a portfolio manager. How active were you this month?
Well, we were fairly well positioned coming into this month, so we've been active in terms of what we're looking for that might have gotten hit with the rest of the stocks. So we were somewhat active, but it's not like we had a much different activity level than normal, because we were fairly well positioned coming into this, because we were concerned about this going into the end of last year.
If someone has a bullish cast, where is the opportunity right now?
I think there's a lot of opportunity in some of the tech stocks that have gotten hit. I mean, you saw that rally in the NASDAQ on Friday. I think part of that was Apple coming out and saying that some of their supply chains have eased. I think that gave people some comfort that some of the issues that they were concerned about are getting a little bit better.
I don't have the numbers in front of me, Sarah, but this is really important. Joe Feldman with Dana Telsey's advisory group has operating income at Amazon. And again, over a longer time frame of 24 months, it's breathtaking, the growth. When you look at the tech stocks, you're not looking at 1 week performance or 1 quarter. How long is your timeline to judge the value of big tech?
I think the timeline has to be pretty long, because some of those companies have grown fairly well for a very long period of time. And when people started to talk about the tech issue earlier on with the rate tightening issue, there is a bifurcation in technology for the companies that can grow and grow profitably. And I've said this before, and I really think that you're really starting to see that. But there are some stocks that have gotten hit with all of this that I think are decent values here. I mean, you've got some 15 times earnings stocks in some of the chip makers. You've got some of the chip equipment makers that are cheaper now too than they were before. And I think that there's some real growth ahead, because you're going to continue to move where we're making semiconductors. If the supply chain issues have taught us anything, I think you're going to see a different people are going to be basing their production of semiconductors in other places than they have been because they don't like the dependency. So I think that there's a long runway for some of these stocks to grow, and I think that is what people are going to be looking for as we go forward.
Sarah, it has never been a fundamental issue. It's always been a valuation issue, at least for 2022. And some people are looking at the potential for real rates in the United States to go to zero. David Kostin, among them, of Goldman Sachs. How much are you including that scenario when you say it is time to start going in and buying some of these high-quality names?
Well, I mean, if you think about the fact that historically we had never seen negative rates before, I think just getting back to zero should not be a cause for major concern. And I think that growth can still happen under those conditions. But the problem with inflation is that it's systemic in ways that is very difficult to fight. The energy issue is one thing, the housing issue is another thing, and those are not that easy to fix. I mean, if you've got a global move away from hydrocarbons without a lot of non-expensive ways to replace them, that's not going to be a transitory issue. That's going to be a longer-term issue. And the housing problem, as rents go up, is going to be non-transitory as well. So I think that just getting back to zero is not a tragedy for most of this group. But I think that the longer-term question is going to be, what does that look like going forward? Where do rates go, and what happens in the interim to inflation?
But Sarah, a lot of people are saying that because of that inflation story, it's the cyclicals that you should lean into and not necessarily the growth names that have benefited by low rates. Do you disagree with that? Are you saying that actually these big names have the greatest capacity to grow with inflation?
I think some of these big names have the biggest capacity to continue to raise prices. The problem with the cyclicals is that if you've got a slowing economy, then you've got, a tailwind on one side and a headwind on the other. And I'm not sure that that's going to be the biggest place to make money, although we think some of those stocks have come down too. So I wouldn't ignore them either. It's really just looking at individually, stock by stock, what does it look like for them in the future for the next 2 or 3 years? What does it look like what does the interest rate do to them, and what do their end markets look like? And I think that's really the kind of individual stock by stock analysis that has to be done.
Sarah Hunt of Alpine Woods Capital Investors. Sarah, what a busy month. All that work last week for a flat market. Just unreal, exhausting stuff. Sarah, thank you. Thank you very much. I was just reminded of RBC's Laurie Calvasina having this conversation, Tom. Reminded of the call she's got for this year. I think it was the front half cyclicals, back half growth, as growth in the economy becomes a little scarcer.
Yeah, she goes all math this morning with her research. No, we don't need to go into the math because my brain's not functioning after watching too much football. But John, it's real simple. She says we've repriced. She says we've really re-gauged the Fed and all that. And basically she says from here up. It's that simple.
Have we repriced enough? And to go back to the Goldman call of David Kostin, Lisa, just working things out. I won't call this a call. It's just kind of calculating what would happen if something else happened. The S&P 500 down 10% from the peak, Jan 3rd to Jan 27th. Valuations have contracted as real rates have risen. That we know. Here's the calculation. The S&P 500 would decline by 10% to 4K if the real 10-year Treasury yield rose by 60 basis points to zero, and by 15% to 3,800 if it rose by 100 basis points. Of course, as they say, all else equal. That's not the base case of Goldman, but that's an important calculation for us all to start thinking about a whole lot more.
And they said that the downside risk is growing, and really the risk is to the downside. When you ask the question, though, have we repriced? Have we basically factored in rate hikes? Perhaps we have. And honestly, here's where the balance sheet comes into play, because the balance sheet potentially could have even more of an impact on real rates. And frankly, the global tightening cycle also having a real effect on where real rates and frankly, long-term rates really end up. And these are some of the questions that have not been priced in because no one has an answer, John.
Are you surprised that no one's downgraded their forecast a month into the year on the S&P? I keep looking around my inbox. I'm just waiting for it. I'm not saying they should. I'm just saying I'm waiting for it.
You're getting the hints of it. Downside risk becoming increasingly apparent.
Yeah, that's where it begins.
It's a slippery slope.
It's a slippery slope, John.
Thank you, Tom. The contribution is valuable this morning, TK.
The pendulum of slippery slope.
We're down 16 on the S&P. We're down 1/3 of 1% on radio, on TV. Good morning to you all. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. US senators are close to agreeing on a Russian sanctions bill, according to Foreign Relations Committee Chair Bob Menendez. The measure could include penalties even if Vladimir Putin does not send troops to Ukraine. The Biden administration will brief lawmakers this week on the standoff. British Prime Minister Boris Johnson has received that report of a government investigation into the so-called Partygate scandal today. The probe by senior civil servant Sue Gray looked into possible wrongdoing over parties at Downing Street during lockdown. Johnson will respond to the report in a statement to the House of Commons. North Korea has added to the largest series of missile tests since Kim Jong-un took power. It appears to have fired one of its biggest ballistic missiles in almost 5 years, according to a Japanese spokesman. The missile flew eastward for 30 minutes before landing in waters outside Japan's economic zone. And in pro football, it will be the Cincinnati Bengals versus the Los Angeles Rams in the Super Bowl. The Bengals rallied from an 18-point deficit to beat Kansas City 27-24 in overtime to win the AFC title. In the NFC Championship, the Rams overcame a 10-point deficit to beat San Francisco 20-17. The Super Bowl is set for February the 13th on the Rams' home field. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Did Delta fundamentally change the sort of infrastructure of hospitals and medicine generally in India, or was this just a short-term phenomenon and things reverted back to the mean?
So it did change. I think from a preparedness standpoint, how the hospital infrastructure sort of geared up for it, and whether it was oxygen requirements. I think most hospitals have put up liquid oxygen plants, temporary plants. Some have put up permanent plants. I think the capacity for oxygen and other, medicines and supply chain has been augmented, enhanced. So from that standpoint, I think there's been expansion in capacity in infrastructure. We've all sort of seen how far we can stretch the envelope.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how CFO Luca Zaramella is using local knowledge to help Mondelez grow its global portfolio.
I know our people, I know our customers. We tend to believe that all consumers are equal. They are not.
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg. Season is here.
It has been brutal.
A little bit of disappointment in some of the early reporting.
Nasdaq 100 on pace for its worst month since March 2020.
Bloomberg breaks the numbers first.
Netflix, of course, is the stock of the hour.
A pretty big miss.
This is a mighty crash.
An expert analysis you won't get anywhere else.
The banks is potentially a bad bellwether.
Not only you're not getting incremental earnings growth, you're getting reduction in earnings growth.
What to buy and what to run away from.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
There's bipartisan support to sanction Russia now, punish Putin now, more weapons to the Ukraine now so they can defend themselves, more economic aid to the Ukrainian economy so they can deal with the threat of invasion, and more troops to NATO. I will just say this to President Putin. If you invade the Ukraine, you will destroy the ability of future presidents to treat you and Russia as normal.
Senator Lindsey Graham there, the Republican from South Carolina, from New York City with Tom Keene and Lisa Brambitz. I'm Jonathan Ferro. Here's the price action this Monday. Down 21, we're negative 0.5%, and we give up some of the gains on the Nasdaq now. Positive just up 0.05%. Into the bond market, yields are higher at the front end and the long end too. Up 2 basis points on 10s to 178.56. Big rally on crude, up 17%. Brent, WTI right now. Year to date, up that much. On a session, up 1/3%, just in case you get too excited. $87 on WTI, $3.90 on Brent. Tom, I said this on Twitter last night. I'll say it again. You are not allowed to complain about penalties in rest of the world football when American football has some of the worst overtime rules I've ever seen in the NFL. Tom.
I think most of the fans
Makes
agree
no
with
sense.
that, John.
The college overtime rules, let's be clear, they're good. Why can't they just do that in the NFL?
Because they are slaves to TV. They are slaves to getting the games done to go to the next game. And I believe within the zeitgeist, I defer to Michael Barr on this, Bloomberg Business of Sports, they're trying to amend it to something commonsensical. I assume they'll do that at the end of the season.
The college rules make sense. Each side gets a turn in possession. You see what happens. I just don't get it. I don't know. I mean, the way it worked out yesterday is the way it worked out anyway, so that wasn't a big deal.
Yeah,
but
exactly.
To have a coin flip and have first score wins, I don't know.
I would suggest, John, that every other major sport is sobered by the success that we've seen the last a couple days. What's really important, folks, to understand here is the Nerd Fest, known as Bloomberg Surveillance. And the way we identify the Nerd Fest is if anyone involved with us is playing Morning Wordle and guesses that the word is LIBOR. That's a pretty sad statement. Anne-Marie Horton down in flames on Wordle this morning as our Bloomberg Wordle.
You're giving away my secret.
How do you pick LIBOR as a Wordle word? You can't do that.
I know. I feel like I'm going to give hints away, but obviously there was 2 letters, L-I.
Very good.
That on the Wordle today, and that's the first thing that came to mind. It's because I spent so much time hanging out with you, Tom.
I guess so. It's way too much time. Let's move on to the Wordle at the White House today. They've got a lot of optionality. We talked about Ukraine earlier. I see rumbles that Build Back Better may have a 3rd or 4th life. Do you buy it?
I buy it a little bit in the sense that obviously this is the president's central economic agenda. He spent last week on a speech in Pittsburgh talking about it. And while he does admit that he's not going to be able to get the entire package done, there are potential hopes that chunks of it will be able to get through. And the Democrats are certainly hoping that at least discussions could take place before he gives that State of the Union on March 1st. It would be very challenging at the moment, given how difficult and the to-do list they have for February to get something done before the State of the Union. But potentially there are talks from aides that there are going to be discussions regarding Build Back Better. But remember, key to this negotiation is going to be Senator Joe Manchin, who just last week in West Virginia on local radio was talking again about how concerned he is about higher inflation.
2022 marches forward, Anne Marie. In a moment, it's February, and we frame March. When does Democratic Party panic set in about their prospects in November?
I think that's already starting to set in, right? You could see how they are trying to sell some of these bills they're negotiating on the Hill. This week, there's going to be a ton of focus on the China competitive bill. That is something that this administration certainly wants to push through. Gina Raimondo has been forthright about that, talking about how this is a way you can fight inflation on one part, and then also the administration, the Democrats, will also talk about that as a way to also fight and be competitive with China. So for them, this is twofold. That's a message they certainly want to take with them into November. And then there's other things like, of course, the sanctions and talking tough on Vladimir Putin, and they're going to be looking across the aisle, showing that they can work in a bipartisan fashion. And then everything for the Democrats are also going to turn to the Supreme Court nominees. So these are really some of these top agenda items for them in February. They're certainly worried about midterms, but they can use these kind of discussions back home with their constituents.
Meanwhile, we definitely have inflation in the front and center for a lot of potential voters, with oil prices rising to the highest level since 2014. Any further discussion in Washington, D.C. about not just releasing reserves, but also possibly propping up production in the United States? I mean, what's the plan?
Well, the plan at the moment is that they're continuing to talk to their OPEC plus allies, and they have a meeting this week. Potentially, we can see whether or not they're going to want to increase production. Really, there's two countries that could potentially do that. It'd be Saudi Arabia and the UAE. Saudi Arabia, though, for the most part, has remained that they are just going to continue along the path that the group has outlined, and many of the other countries are struggling to even reach their quotas. So it does put the administration in a very hard place. Even if the administration wanted to go to Chevron or Exxon and say, I need you to produce more oil and gas, these are not state companies the way Aramco is to Saudi Arabia, the way Rosneft is to Russia. So it's difficult for the administration, and it's a very hard position they face because they clearly want to get gas prices down. When you look at Brent crude north of $90 a barrel, this is something that's alarming for the White House.
Did Anna Marie spoil Wordle? Did she spoil it, Lisa?
She spoiled it for the control room before the segment.
Did she give away a couple of the letters, though?
Really, you're going to ask me to confirm the spoiling?
It's
so
Monday
I get involved
morning. Everyone
in the spoiling
deserves a little bit of a leg up.
of a pocket of joy, which is to figure it out themselves.
She's so
I'm not
fired
going
up
to
about this, both of you are.
I really enjoy Wordle, so I'm going to just leave that there.
I can tell. AMH in Washington, thank you. We need to get Guy Johnson in London on standby, Tom Keane, to explain all of this when we actually get the report. We understand from the Prime Minister's spokesman, Max Blaine, that Partygate and its report will be published as received. And they will publish that report, Tom, before the Prime Minister's statement. I don't know when it will be published, Tom, and I don't know when the Prime Minister's statement will be, but there you go.
What are they going to say? I mean, look, in I think it's Commanding Heights, Daniel Yergin, I can't remember what. They've got the liquor list of Winston Churchill on the boat over to Yalta. John, I've never imagined that much alcohol, and I think it was all drunk in like 4 days, not only by the Prime Minister, but by, a cast of 100 characters or whatever. We've gone from Yalta in Churchill drinking down to what? 6 drinks?
I think we're going to find out, Tom. Maybe. It depends how much of this report is redacted because there's an ongoing police investigation.
I mean, John, I'm just going to suggest on the second floor are rules where they have those lovely little cocktails. I mean, is that Partygate? I think it was.
I'm suggesting that you might be suggesting that this is a reason to visit London.
It's a reason to visit London to test Partygate.
Remember when Tom became the Brexit correspondent just so he could go to London every 2 months?
Oh, yeah.
From New York, this is Bloomberg.
Omicron variant and the latest wave have an impact on not only consumer trends, but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Live from New York City, looking to close out a brutal month of January. If you were long and long the Nasdaq, I'm sure it hurt. Futures down about 0.5% on the S&P. We do turn into negative territory on the Nasdaq right now. The Nasdaq coming in about 0.1%. The Russell, where the underperformance is. The small caps down by 1.2% on the month. We're down about 7% on the S&P. As you might have heard, the worst month going all the way back to March 2020. A little bit earlier this morning, I promised you I'd talk about the Standard Chartered bond market call. So we can do that right now. 2s, 10s, and 30s. And take a look at 2s. So here's their call. They go from 1.1% to 1.6 for the end of Q2, and then they look for a move, just a subtle move lower to 1.5 to end the year. And this is how they frame their call. The hawkishness up front, and then for them, much more dovish as the year progresses. So they're looking for hike, pause in July, and then stop. And for that reason, they see the peak on the 2-year in the middle of the year, not the end of it. So 2's right now at 120. Let's call 119.86 120. And let's say on the year, because we are about year to date up 47 basis points. And let's talk about the shape of that curve. And bear in mind that Standard Chartered think the Fed backs away because the back end of this year, growth starts to back away too. So 2's up a lot, 10's doing something, but not as much. And 2's, 10's rolling over. On the year, down around about 17, 18 basis points. That's a flatter curve. Year to date, over the last 12 months, Tom, we're down 37. That curve's flatter,
it's the way
flatter,
we're down.
flatter.
I mean, this is really important, folks. For those of you on radio, John is showing the correct arithmetic chart of 2's, 10's spread. John, to get the rate of change, the first and second derivative, you go to logs on the y-axis, and it's breathtaking how 2's, 10's is flattened.
The heavy lifting, Lisa, has come from 2's. And a lot of that is what's behind some of these calls we're hearing on Wall Street right now.
And
From Morgan Stanley at 4 to Bank of America at 7 hikes this year.
And the idea that they're not going to go much further, and that frankly the terminal rate's not going to be much higher than it has been in the past. And that, I think, is the highest degree of uncertainty, that long-term run rate that we just don't know.
I think it's a really important point, John. The terminal rate is a massive guessing game right now. And frankly, somewhat this week's data may allow people to judge a better terminal rate.
TK, you used the G word, and I think it's so important. Guessing.
Yeah.
When we talk about neutral, let's think about where the chairman of the Federal Reserve was at the back end of 2018. Guessing. He was talking about maybe, probably, we're far away from neutral. Then the market started screaming in December. They backed away. We'll see. I mean, the chairman last week, Tom, said that they could hike interest rates maybe a fair bit, probably, without threatening the labour market. Again, we'll see. And as for the labour market this coming Friday, mentioned that Bank of America call at 7 hikes for the year ahead. They're looking for a contraction on payrolls, Omicron-induced, of negative 150K. I'm fascinated to see how the market might respond to a negative print on payrolls, given this rate hike conversation at the moment. Bank of America still say full steam ahead, but again, we'll see. A lot of we'll sees. this morning, Lisa? That's your cross-asset price action. Let's say good morning to a very busy lady, perhaps the busiest lady at Bloomberg TV and Bloomberg Radio. Good morning, Kaylee.
Oh, good morning, John. We're all busy here, and it's a busy action in the pre-market session as well. Potentially some deal action when it comes to Citrix Systems, the software maker reportedly about to be bought by Elliott and Vistor Partners for $104 a share. That is slightly below where it closed on Friday, and it is trading below that level in pre-market this morning, around 102, down about 3.25%. Also moving to the downside is Robinhood. Remember, this stock hit a record low last week. Then Cathie Wood came in on Friday to buy a couple million shares. Not a lot of people apparently joining her in that, though, with the stock off about 4.4% before the bell. One mover higher is Spotify. I'm sure you've all been paying attention to the saga over the last week or so. A lot of concern about Joe Rogan's podcast. Very popular, not necessarily the most accurate when it comes to COVID-19 vaccine information. So that has created kind of a revolt. Spotify saying they're going to change the rules. Joe Rogan apologizing, saying he will try to do better research. That stock up about 1.8% after wiping off about $4 billion worth of its market cap last week. There's also a number of stocks moving higher on analyst recommendations, one being Tesla getting upgraded with a $1,025 price target over at Credit Suisse. Dan Levy saying he's hard-pressed to find another stock that checks as many boxes as Tesla does. It's up 1.4%. Netflix getting upgraded over at Citi. The analyst saying, yes, subscriber growth may be slowing, but pricing power is what's going to be important there. It's up 2.6%. You also had Envista, the dental company, getting upgraded at Morgan Stanley. So it's moving higher to the tune of about 1.4%, Tom.
Katie Lyons, thank you so much. Now on bonds, Ed Al-Hosseini joins us, global rate strategist, Columbia Threadneedle as well. Ed, what does yields do if we do get a growth slowdown?
Yeah, it's really interesting conversation between what the yield curve does in terms of continuing to flatten as growth slows, and at the same time, what do credit markets do at the intersection of the growth slowdown and the Fed continuing to tighten. And I think just to go back to your conversation around neutral rates, we will know when we're approaching neutral when we have that widening in credit spreads. And we may be at the early stages of that right now.
We're at an early stage of gaming the Fed. I'm fascinated how you put it into play within the fixed income market. You talk about credit spreads widening. How do you actually play that to protect capital?
Yeah, absolutely. I think particularly in the treasuries market, what we do is we look for carry. And at the moment, the carry opportunities in the front end through the belly of the curve are quite attractive. I don't think you want to be at the very front end inside of the 2-year segment, where again, the risk is that the Fed accelerates the pace of tightening. But once you get out to the, sort of the 3 to 5 year segment, the carry gives you enough cushion for an event where the Fed starts to slow and potentially undershoots what's in the price. So I think that's the sweet spot for me at the moment is the belly of the Treasury curve.
All right, so you're talking about the Treasury curve, but you were talking earlier about credit spreads, and I want to go there because typically people look at that as a leading indicator for a risk-off in sentiment. Although we've seen equities really sell off, credit spreads have been pretty tame. You are seeing them increase just a bit. Have they lost their ability to be a forecasting agent?
No, I think credit spreads in aggregate remain probably the best indicator of financial conditions. So again, think about the Fed at the moment is targeting tighter financial conditions in the course of this year. It's an important force multiplier for what the Fed will do with the Fed funds rate in the course of the next 12 to 18 months. So the Fed needs those credit spreads to widen. The fact that they've done very little in the course of this month, they have moved wider, but relatively modestly, really reflects the fact that fundamentals are very good. Corporate fundamentals are exceptionally strong going into this year. And so the Fed's going to have to fight those fundamentals in the course of the year. So I think it's too early to kind of write off credit spreads as an indicator of what's going on in the economy. I think they're still quite good.
Do you think that for high-grade bonds, they actually could potentially see more spread widening just simply because of the revaluation that you're seeing in high-quality stocks? I mean, it's the same kind of a discussion that you're seeing in bonds.
Yeah, I think it's this combination of where's the tipping point. The starting fundamentals are good. Corporate balance sheets are solid. They're cash rich. Even though leverage has gone up, the cost of servicing that debt is exceptionally low at the moment, and corporates have turned out that debt in the course of the last 12 to 18 months. So we have that exceptionally good backdrop. We also have a good backdrop in terms of the consumer. What we're starting to run into is, of course, the Fed is starting to move and the Fed's tightening financial conditions, and growth is starting to slow. Organically, again, think of the handoff from Q4 to Q1. Q4 growth was a 6 handle. Q1 is tracking about 0. So that organic growth slowdown should start to see or should start to show up in wider credit spreads. Again, relatively slow at the beginning, but they should start to move wider in the course of the year.
Ed, your first comment there, I made some notes on it. Credit will let you know when neutral is. We may be in the beginning stages of that now. Ed, the Fed hasn't done anything yet. So I'm just wondering, if we're in the beginning stages of it now, Ed, how high can they go?
I mean, this is the big debate. This is the disconnect. The yield curve is telling us that the amount of space that the Fed has to maneuver is relatively limited, right? So they can go 5 to 6 times this year. I think about 150 basis points or so. That will likely start to invert the curve unless we get some surprises on the fiscal front. And at the moment, of course, fiscal policy is moving in the other direction. So the amount of space that the Fed has is quite limited. And I think credit will catch up to that by the end of the year.
So Ed, if it's slowly then quickly and all at once, what business do I have sitting in credit right now? Is this a sit in cash and wait?
That's a really difficult question. I think, again, if you look at certain segments of credit, of course, there are quality issues that I think, again, the underlying strength of corporate balance sheets provides us a significant buffer going into this environment. So it's quite different versus, say, 2018 and 2017. At the same time, we should start to see, in aggregate, slower growth show up in wider credit spreads. So what you're playing for is how much protections you have in terms of the carry, particularly in higher yielding segments of credit, versus how scared are you of the Fed accelerating the pace of tightening over and above, say, 150 basis points this year. That's the balance at the moment.
Ed, thank you, sir. Just fascinating stuff, really is, this debate right now. Ed Al-Husseini there of Columbia Threadneedle. Lisa, can you imagine that this process might already be beginning, in the words of Ed there, and yet the Fed hasn't even had liftoff yet?
Well, it's all in expectations, right? That basically you've seen a repricing in stocks. But I think the point is you have not seen a wholesale repricing in credit. You've seen some repricing, but not to quite the same extent. And basically what Ed was saying is that you will see it as the Fed takes action. So do people get ahead of it? I mean, I think you asked the right question. Why not get ahead of it if you really believe that?
But this is the issue, isn't it? Of course it's based on expectations, but this is why often and frequently over the last 10 years, the more this market prices in of the Fed, the less the Fed can actually deliver. And you see it time and time again. Tom, the forecasts on the street above and beyond ultimately what the Fed ended up delivering.
It's an overlay of, it's a time to pivot, and granted some of it's a pivot off the pandemic, but it's also the natural disaster that is this pandemic. What are we going to do, John, if we get a constructive overlay of Omicron on all this gloom about higher rates? I don't think anybody has a clue. I certainly don't.
We'll catch up with Rob Rosner on that, the senior U.S. economist at Morgan Stanley. They're baking in 4 for 22 and perhaps more. Futures down on the Nasdaq, 0.1% on the S&P, negative 0.5% this morning. Good morning to you all. TV and radio. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Several developments in the crisis in Ukraine. The United Nations Security Council will debate the issue today, and the Pentagon says that Moscow has increased the number of troops that have been deployed along the Ukrainian border. Russia's President Vladimir Putin says he has no plans to launch an invasion. Atlanta Fed President Raphael Bostic says the central bank could do a half-point interest rate hike in March if needed to fight inflation. In an interview with the Financial Times, Bostic stuck to his prediction that the most likely scenario is 3/4-point increases this year. The Fed typically, of course, raises rates in quarter-point increments. Meanwhile, this week, the Bank of England will give a big clue about how far and fast it will move in fighting inflation. According to a Bloomberg survey of economists, BOE policymakers will raise interest rates to 0.5% on Thursday. That would complete the first back-to-back increases since 2004, and it would raise the question of whether more increases will follow. And Spotify is trying to end the controversy over misleading coronavirus vaccine information. Star podcaster Joe Rogan has pledged more balance and better research for his shows. Singers Neil Young and Joni Mitchell pulled their music from Spotify last week, to protest Rogan, who has hosted outspoken critics of the vaccine. Spotify will also add content advisories. And the pandemic shift to working at home has spurred blue-collar Americans to seek a career change. A new study by the Oliver Wyman Forum found that the desire for more work flexibility was a key motivation. It also said that almost 4 out of 5 who tried were indeed successful. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
$100 is certainly within the realm of what we could see in the next few months. Longer term, we think markets rebalance and prices will moderate.
What a month for crude. Mike Wirth there, the Chevron CEO. From New York City with Tom Keene and Lisa Abramovitz, I'm Jonathan Ferro. Your equity market slightly negative on the S&P, slightly positive on the NASDAQ, up a tenth on the NASDAQ 100, on the S&P down around a third. Yields are higher by 2 or 3 basis points on 10s by 179.63, up just a little bit on the day. On the year to date, just an unbelievable move at the front end, up by almost 50 basis points on 2s, Tom, as we start to race to price in a tighter Fed this year.
It's going to be interesting to see. We've been talking this morning about the vanilla spread of the fixed income market, the difference in yield between the 10-year and the 2-year, the so-called 2s10 spread. In the oil market, the vanilla spread is those two visible giants, Brent crude, the global price, and West Texas Intermediate, the American price. Always a difference. What, Critty Goop, now about $4, 4-ish?
We're at $3, I think 47 cents. So we're getting very close to that $4 level, which to your point is a crucial one. Let's just take a quick look at the chart though here, because you're seeing a big steep acceleration between the spread between WTI and Brent. For our radio audience, this is significant. You haven't seen this kind of drop in a while, at least in the last year. And a lot of this has to do with that Russian risk. They are pricing in that geopolitical premium that is so crucial that you're starting to see. The idea that not only could you start to see an actual invasion from Russia, the odds in the US and the UK really ramping up for that, but also potential sanctions even without that Russia invasion. At least that's what's going through Congress. And that's getting priced into the spread in particular. But Tom, you mentioned that $4 crucial level. Bob Yager over at Mizuho Securities, he points out that that $4 level is so significant because it makes WTI too cheap for international refiners to ignore. Essentially what happens is international refiners then go in, right, they go in, they buy U.S. oil instead of U.S. refiners going to buy international oil, and it ends up impacting that kind of export-import trade balance.
Critty, thank you so much. Critty Gupta there quickly, and we go to the perspective of Javier Blas of Bloomberg Opinion here on the dynamics of oil. Javier, I did a log extrapolation of Brent crude today, and we hit $100 a barrel by February 22nd. Why is oil going up, and why is it going up in such a measured, responsible way?
Well, Tom, demand seems to be quite a lot stronger than we were expecting. Certainly has surprises to the upside. Omicron have very little impact on demand. We are revising up the consumption numbers that we were thinking already they were quite strong in October, November, and December. We are beginning to upgrade those numbers even higher. And the market simply needs more oil from OPEC, and OPEC is producing or increasing production on very little increments every month, and actually is failing to deliver the increases that they promised. Every month say that it's going to add about 400,000 barrels a day. It is not increasing as much. Sometimes it's even half of that, only 200,000 barrels a day. So the market is moving to a point where we get more oil from wherever it is. And that, wherever it is going to be the U.S. shale path is Texas, and for that we need high prices.
Can Russia affect the price of Brent crude?
It can. It can certainly affect the price of oil. Russia is the world's third largest oil producer and one of the largest exporters, only behind Saudi Arabia and the United States. And if Russia was to restrict exports of oil, certainly it could make the oil market look even tighter than it is today. I don't think that Russia is going to go to that route. But what we are seeing is that Russia is already struggling with his increases in oil production. It's failing to increase as much as we were expecting. And that's because the Russian oil companies are reaching to the limit of what they can do in the short term.
Javier, we saw that actually oil demand or gas demand has declined in Europe or hasn't risen as much as people had expected because there are signs of demand destruction as a result of the price. How much will this actually help correct prices?
Well, it will help, but actually price is helping, is reducing some of the demand. But on the other hand, we are seeing in Europe that still a lot of the population prefer to use their cars rather than public transportation because of fears over COVID. And that is more than enough to offset the impact of high prices on demand. So demand actually has surprised to me to the upside. I'm going to give you a number, for example, from my home country, Spain. In November, we saw the best consumption for that month in 11 years. That's a sign that consumers are not using public transportation and sticking to their private bubble of security or safety that is their own car.
Given the fact that you're not seeing as much demand destruction as you'd expect, how much are we seeing the marginal suppliers start to pick up the pace? And I'm thinking in particular of the shale patch.
we are beginning to see an increase, and shale production is going to increase significantly this year. It's not going to be back to the days of drill, baby, drill, but certainly the price is there for U.S. shale producers to increase production. Recently, one of the consultants in America is saying that the price is not just a call for shale producers to pump more, it's a cry for shale producers to increase production, and I think that they are responding.
Javier, just finally, the last time we were here 8 years ago, when prices were this high, a month later, the Saudis started a market share war. Can we finish on that? Javier, what has changed in the 8 years since then? Why is this moment at 90 perhaps different to the moment at 90 back in 2014?
Well, I think that one thing that has changed significantly is that we have a lot less investment in the industry. Every Wall Street large investor has moved out of oil. And that means that the big oil companies are not as willing to invest as they were in the past. This is a rally that is being driven by a strong demand, but on the background, there is a lack of addition of supplies. Whether that changed with $90, $100 is hotly debated in Wall Street, but the big change is that the market, the supply response is not as quick and effective as it was a few years ago.
Javier, fantastic. As always, buddy, it's good to hear from you. Javier Blas there on the commodity price, oil price situation. Tom, 8 years and a lot of change, TK. A lot has changed in 8 years.
Well, a lot has changed, but also I'd note, and Javier sent a note around on this earlier this morning, we're seeing a lot of other commodities move up. Coal basically is at a record high. I mean, just on usage. And again, it's this misjudgment, John, of demand, again, given the challenges of a tangible, ever-changing natural disaster.
Tom, whether we're talking about coal or we're talking about oil, we're talking about a similar story, aren't we? This massive energy transition that Javier alluded to at the back end of that conversation, and ultimately the lack of incentives for people to put money back into the ground and to pump.
What are we going to do? Go after big oil when we hit $100 a barrel? I must admit, John, if we hit, where are we right now? 91.07 on Brent crude. If we go up $9, does the dialogue change?
We've been going after big oil for much of the last 8 years.
Exactly.
And beyond, and that's intensified recently too.
Yeah, this really talks about the gap between trying to get to a green transition and the fossil fuels that really do fuel our world. Talking about commodities, though, in coal, one commodity that I've been watching is aluminium, John, for you, that it's rising anytime. It's had an incredible rally, and it's because partly the cost to get it out of the ground is increasing on the heels of the higher fossil fuel costs. Just giving you a sense.
I'm happy to call it aluminum.
I don't know if I'm happy to say aluminium.
It's quoted 3,052.
I'm a team player, it's fine. Put this in the schedule, 3:30 local time. You will hear from the Prime Minister, so that's 10:30 Eastern time.
My world will stop for that.
I have no doubt about that, Tom. If you can stay awake for it, it'll happen a little bit later from New York. This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I like to say the Fed specializes in crowd control. They're coming undone, and they're being compromised by this thing called inflation.
Inflation at a 7 handle is just not acceptable.
You need to decide whether you're going to stabilize inflation or growth.
If you see Chairman Powell really wrestling with inflation, you could see much higher volatility.
It's not going to be a year of a rising tide lifting all boats.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. A Monday, a dash into February. And John, tons of economic data. We're going to reframe 8:35 Friday morning.
Look out below on payrolls. The range is still wide. It always is at the moment. 250 positive all the way down to 400K negative. Will it change the conversation around the Fed, given this is an induced slowdown, an Omicron-induced slowdown, Tom Keene? You said the asterisk next to that number will be shining bright this Friday.
It's going to be fascinating to see. With Lisa Hornby coming up here in a moment. John, what I think is so important is the backdrop of this, and I'll lead with Feroli and Kasman with a 1.5% GDP in this present quarter. We're doing this within slowing economic growth. That changes the dialogue.
I'll lead with Bank of America, Tom. They're looking for a hike at every meeting this year. 7 hikes through to year end, a peak in the Fed funds rate, 2.75 to 3%. That's the outlier call at the moment, Tom. The direction of travel, though, has been moving in that direction. The center of gravity, 5 hikes right now, Tom, for 2022. That's the call on Wall Street.
Lisa, what's so important here then is the mix here around the pandemic. We see cases rolling over, hospitalization rolling over, maybe deaths too. I'm getting some constructive tone. And from strategists, it's a fairly constructive tone within a lot of different angst.
It's fairly constructive, but on the edges, there is this growth concern that we've been talking about for a couple of weeks now. And I keep going back to the yield curve. Is this an instructive tool of something like the U.S. economy can't really withstand much higher rates in the longer term, because that seems to be the suggestion. Is this still a telling tool, or has it been corrupted by some of the Fed policy and, frankly, the international policy, at least as a pure read on what's going on, Tom?
John, what's going on in the spirit? We're going to interrupt the program right now, John.
Sure.
This is so important, and it's about the cloud and how Apple adapts to it. Thursday, we've got Amazon in the cloud. Microsoft with stellar earnings X number of days ago. And here's Elliott stepping in at this moment, as suggested over the weekend, and they take out Citrix, which we use at Bloomberg, as part of our cloud technology.
People are still deploying cash, Tom, even with the threat of higher interest rates. They're getting to work, and maybe in some cases that's why they're getting to work, because some of these valuations have come down so much. We talked about the Microsoft deal. They're basically paying for that acquisition what the company was worth, Tom, 12 months ago. We've had a big correction.
It's life goes on, and you see that within the data this morning. The VIX from 32, John, down to a 28.87, more constructive in the last 2 days.
I keep smiling because you let that comment from Lisa slide. She used that word corrupt. They've corrupted the yield curve. Lisa thought I did not miss that.
I know, I thought it was so impressive.
The Federal Reserve has corrupted the yield curve.
I didn't say, whoa. You sort of reframed it. I'm saying has been corrupted by policies. Basically,
I'm just
look,
saying
it's a
what
very
you actually
strong
meant.
word.
Let's be clear.
Look, it's a very strong word. The idea here is, have we distorted some of the traditional signals that we've traditionally relied upon? And if we have, then what does that mean in terms of this guessing game that we've been talking about all morning? I've been struggling with
I
this.
just love the word choice. That's all.
Okay,
They've corrupted it.
It's Monday.
10's up 3 on your 10-year right now, 179.63. Equities come in on the S&P, down 0.4%.
Thanks, John.
We're down, come on, you can't let that slide. That was beautiful. They're going to love that.
Oh, dear Lord.
Yields up a couple of basis points, Tom. Equities softer. Crude still positive, 87.27.
Curve flattening with some real velocity. Thank you, Javier Blas and Kriti Gupta, for perspective on oil. 91.06 on Brent crude. We start strong with Lisa Hornby, head of U.S. multi-sector fixed income at Schroders, with a backdrop out of her Rutgers economics and the great Michael Bordeaux as well. Lisa Hornby, you are grounded in economic history with Bordeaux. Place the economic history right now as you allocate forward to the market. How do you combine all the econobabble into an investment view?
I think it comes back to Lisa's comment earlier about things being corrupted. I mean, I would take that a step further and
say, up and going with the corruption baton.
It's not yield curve, right? It's not just the yield curve that's been corrupted. It's all financial assets. I mean, you look at the price appreciation we've had over the last couple of years, and you'd say nothing could justify that except for the fact that we've had literally trillions of dollars poured into the economy, thanks to both Fed and policymakers. And markets now need to correct to some level of normalcy, and that's what we're seeing. We're in a transition phase now. So, our view on risk assets is a little bit more cautious. I think we've spoken about that on this show for the last couple of months. When you get valuations in the bottom quartile, and we were in the bottom decile, I think in November, you have to be a bit more cautious in your approach to risk taking. So that's where we are. We look at all-in Treasury yields right now, and we say they do offer a little bit more value, and the market is discounting a lot in terms of the Fed. Maybe we could go a little bit further, but certainly we think we're a lot of the way there at this point. And so, we're kind of being cautious and waiting for the macro backdrop to stabilize a bit. Hopefully, the Fed gets this right. I think the chance of that is fairly low, but hopefully the Fed does navigate this well and doesn't over-tighten into a slowing economy. But if they can sort of land this well, then there should be opportunities for more risk-taking later this year.
Lisa, I'm relying on other programs and other networks now for Fed speak, because no Fed official's coming back on this program anytime soon. In the FT, Atlanta Fed President Raphael Bostic just opening South up to maybe needing to go quicker if they need to, maybe not if they don't. Lisa, he's still sticking with maybe 3 hikes for 22. I'm just wondering, in your mind, where the gap is right now between the communication we're getting from the Fed and what the market is baking in. Do you think that's a widespread, or do you think it really narrows the next time we get the dot plot, say, from the Fed in the middle of March?
So, I've seen some of the street forecasts out there as far as high as 7 hikes. I think that's too much. I don't think the Fed gets there. I think the market disconnect between the Fed and 2022 is probably not that material. My base case still at this point is that they probably do 4 25 basis points hikes rather than 5. I do think inflation peaking will give them a chance to pivot off of something slightly slightly as aggressive as they are now, so become a little bit less aggressive. I think where the gap is probably next year. The market is discounting very, very little. I think you probably need to shift some of what's in 2022 into 2023. So I think that's probably where the bigger gap is, and the overall terminal funds rate is still fairly low in the market. So between 1.75% and 2%. That's still a very, very low terminal rate. I think there could be a little bit of scope for that to move higher as well.
Lisa, you said something earlier that the chances of the Fed well orchestrating a soft landing is fairly low. Can you walk us through what it looks like if they fail to? I mean, what you see in your likely scenario in terms of tightening and subsequent economic reaction?
Yeah, I mean, I think it looks a lot like what happened in 2018, where the Fed was basically over tightening into a slowing economic backdrop, and they were forced to pivot in the first quarter, actually the first month of 2019. I think that's the template. This time, I think there's potentially even more danger of that, right? A lot of the market, at least in financial asset terms, has been predicated off the fact that we've had very, very negative real yields for quite some time. If we continue to see real yields normalize, which I think they should to some degree, that should put some pressure on how other financial assets, how risk assets are discounted. And that macroeconomic backdrop, that volatility, is a bit concerning. It doesn't immediately translate into slower economic activity, but if it happens too aggressively and too quickly, and we start to see companies question the backdrop and make different decisions based on hiring, that could pose a challenge. So it is financial conditions ultimately that we're watching. I think there's a lot of metrics that feed into that. So far, they're relatively well contained. I think the other part of it is that Powell was pretty clear that financial conditions don't matter insofar as the household balance sheet is strong. And so that's what they're watching. And I suppose there is a potential for a gap there, right? The household balance sheet can remain strong for some time because there are still some excess savings. People are employed. We've seen wage gains. Household net worth is high. That could probably remain a little bit stronger than the financial asset backdrop for some time.
Elisa, as you look across sectors, just quickly, I want to finish on this. Some people have been raising cash. And I wonder, as you look across sectors right now, what you'd be using to fund that cash position, where you'd completely walk away from in credit right now. Can you do that on a sector-to-sector basis? Is it an individual name, single name to single name? What's the process you go through to do that?
I don't think it's as simple as that at the moment. I think you have to watch the companies you own. I think we're seeing the companies that are doing M&A get hit a little bit harder, at least at the outset. I think we have to be careful on security selection here. I mean, I think it's about taking broad beta down, but there has been sector outperformance, right? Energy has done well, at least in credit markets so far. Triple Bs have outperformed on a beta adjusted basis. So, I think you have to be more specific than just say cut a sector. At this juncture, it's more about the individual names and the overall level of beta in your portfolio.
Lisa Smart, as always, good to catch up. Lisa Hornby there.
Thank you so much.
On this credit market, Lisa, and the difficulties right now, just managing money, given the volatility we've seen through 22 so far.
And the lack of certainty and the lack of signaling that you can necessarily rely upon because of not just the Fed, but central banks globally and some of their interference and some of the market functioning. I mean, right now, the amount of debt that has negative yielding globally has fallen to the least since March 2020. This is a sea change in the world economy, and how this feeds out is highly unclear.
It's a big change. We're pushing ahead to Friday. Payrolls Friday, just around the corner. The median estimate, 150K. We're preparing for a weaker number over at Citi. Their number is 70K, but they're still looking for 5 hikes this year. 70K, and a Fed, they say, that will look through the weak reading. That's teeing up Friday. Yields up 3 basis points on 10s, 180.34 with Tom Keene and Lisa Brambitz. I'm Jonathan Ferro. For our audience worldwide, heard on radio, seen on TV, with futures lower, down 0.4%. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. US senators are close to agreeing on Russian sanctions bill. According to Foreign Relations Committee Chair Bob Menendez, the measure could include penalties even if Vladimir Putin does not send troops to Ukraine. The Biden administration will brief lawmakers this week on the standoff over Ukraine. In Washington, congressional Democrats return to work no closer to a deal on President Biden's tax and spending plan. That comes at a time when American families are feeling the financial squeeze of soaring prices. Average wages are falling behind inflation, and consumer sentiment plummeted in January to the lowest in more than a decade. North Korea has added to the largest series of missile tests since Kim Jong-un took power. It appears to have fired one of its biggest ballistic missiles in almost 5 years. According to a Japanese spokesman, the missile flew eastward for 30 minutes before landing in waters outside Japan's economic zone. And British Prime Minister Boris Johnson has received that report of a government investigation into the Partygate scandal today. The probe by senior civil servant Sue Gray looked into possible wrongdoing over parties at Downing Street during lockdown. Johnson will respond to the report in a statement to the House of Commons. And Elliott Investment Management and Vista Equity have agreed to buy software maker Citrix Systems. The deal is valued at about $16.5 billion, including the assumption of a Citrix deal. Citrix makes software that workers use to log onto their corporate programs virtually. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how CFO Luca Zaramella is using local knowledge to help Mondelez grow its global portfolio.
I know our people, I know our customers. We tend to believe that all consumers are equal. They are not.
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
What would you like to achieve next in Saudi Arabia?
As you know, Barrick has invested in Saudi Arabia already in a partnership with Ma'aden, the state mining company. And we have an investment in the Jabal Sayed copper mine, one of the lowest cost, highest grade mines around, actually. And we have a real commitment to grow our footprint in Saudi Arabia with a particular focus on the Arabian Shield in partnership with Ma'aden. And so after tomorrow, I'm on the way to the mine. So not only how to be at the conference, but more importantly, to go and work with our team out at the mine who've really done a great job managing the COVID crisis over the last 2 years.
that capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Earnings season is here.
It has been brutal.
A little bit of disappointment in some of the early reporting.
Bloomberg is fastest with the numbers and analysis.
This is a mighty crash.
What to buy and what to run away from.
Bloomberg, the fastest numbers and analysis you trust.
You need to be selective in this sense. Look for those companies in those tight supply and demand sectors like energy. And then to drive those earnings, the main lever is going to be pricing power. Companies which have the pricing power to overcome inflation will be able to drive those earnings, and they should get rewarded this year.
Brilliant from Sarah Malik, as always. Nuveen, Chief Investment Officer with Tom Keane and Lisa Bravitz. I'm Jonathan Ferro. Your market's lower, down 0.4% on the S&P. The Nasdaq just about in positive territory, up by 0.04%. Over the weekend, Bramo Publishing. Here's the story you need to read from Sunday. Credit traders lack the edge in the Fed's new regime. The corporate bond market used to be the economy's early warning signal. Lisa says that is no longer the case.
My point being that we're all talking about the equity repricing, and people are talking about the slowdown as featuring into what we're seeing in the equity markets. We're not seeing the same type of repricing in credit, and that I think is compelling, this idea that you're not seeing that massive spread widening until now, and that frankly it's lagging behind other signals, and it just, that's not how it used to be known.
A brilliant piece on the Bloomberg terminal and on Bloomberg.com, perhaps because the Federal Reserve has corrupted the credit market. Okay. You know, seriously, a brilliant piece. And I have to say, if you're listening to this on radio, the picture selection of Lisa Bravitz for this article, Tom, is pretty special too.
It's special.
I missed that. I mean,
Let's move.
For those of you on radio, it brings me to silence. What can I say?
It's actually a brilliant piece. Lisa, how often are you going to publish now? Every Sunday?
Yeah, every Sunday.
Fantastic.
Thank you.
Very
Looking
good.
forward
Lisa
to it. Wonderful.
Bravitz there when she's not tuning the Bramo cam as well. Futures negative 17. The VIX moves higher a point off the buoyant Friday close, 28.92. Gina Martin Adams is with us to assess earnings forward, chief equity strategist for Bloomberg Intelligence. And Gina, I was blown away by your colleague Anurag Raga's work on Amazon, which we see Thursday as well. How does a pro like you frame the unimaginable spending of CapEx by the cloud providers? To me, I can't get my hands on the size of it, and I love what Anurag says. He calls them hyperscalers. How do you value hyperscalers?
Very carefully is the short answer, Tom. I think that it is one of the key questions for investors because we've sort of underappreciated the trend in CapEx. Really for the last 6 months or so, capital spending has been surging, certainly contributing to overall growth and absolutely contributing to bottom line earnings growth to a much greater degree than analysts had even forecast. And analysts are pretty optimistic, frankly. Our view on the overall capital spending outlook is that we're going to have the strongest capital spending boom in at least 30 years over the course of 2022, reflecting a much stronger than expected sales recovery over the course of the last 2 years. And I think it's absolutely impacting earnings. It certainly is contributing to elevated valuations, though we've obviously been focused on rates as the primary driver of valuations for the last couple of months. I think this underlying certainty with respect to the earnings stream is keeping economic conditions afloat, and certainly a portion of that is coming from these heavy spenders, which are impacting the entire chain.
And then look at the CapEx that's being spent, and obviously there's an optimistic tone there on what it means for valuations. And then just moments ago, acquisitive Elliott comes in and takes out another cloud doer, Citrix as well. The dovetail of these two different but immovable capex forces, cash forces, I should say, to me is completely underestimated.
It is, and I do think that M&A is going to be a key characteristic of this environment, provided interest rates don't accelerate too quickly. But the fact that we've had major acquisitions announced in the course of the last several weeks while interest rates were as volatile as they have been does again send a signal of somewhat degree of confidence from corporates that is not necessarily evident in pricing dynamics right now. I do think what we've done over the last couple of weeks is completely underestimated the power of the economy and the power of the earnings stream. And that is where we get our optimism for the year. I mean, our overall fair value estimate is for stocks to sort of muddle their way through this year. But the positive side of that is earnings that are persistent, earnings that are consistent, offsetting what is valuation pressure coming from interest rate rises.
So, Gina, with that equation, that sort of risk-reward equation on the table, how do you determine when to get involved, when to buy a dip, or that we just haven't gone far enough?
Well, bottoms are always characterized by technicals. Bottoms are never, you can never time a bottom based upon fundamentals. I mean, you obviously have your benchmarks for where you expect valuations to trade based upon your anticipated economic and interest rate outlook. But frankly, bottoms are always sentiment washouts. And I think we did at least have one near-term sentiment washout on Monday of last week. You look at things like RSIs, you look at things like oversold levels on stocks, the percentage of stocks trading above their 50-day moving average. All of these characteristics usually frame bottoms. Longer term, I think you do need to pay attention to where valuations are, but valuations on a relative basis are significantly more important than valuations in a vacuum. I mean, I think if you listen to popular consensus, you would get the notion that stocks have been too expensive for going on a decade. But the reality is stocks in comparison to bonds is really what drives capital flows. And that comparison is what has kept equity valuations afloat. So you want to keep a very close eye on what's happening in the bond market. As long as interest rates are stable or relatively stable, and especially when real interest rates are negative, the value of stocks is going to remain elevated.
Gina, awesome. Gina Martin-Adams of Bloomberg Intelligence, leading the stocks team. This from UBS and Luke Cower. Their outlook as follows. This is not a growth scare. This is a valuation-centric sell-off. They go on to say that 10-year U.S. inflation-adjusted yields have risen more than 50 basis points since the start of the year. A move that big, they say, that fast, typically causes discomfort for risk assets. And, Tom, that's what we've seen. The question you've been asking, Tom, is what happens when we conflate a valuation-centric sell-off with a slowdown story, a, quote, growth scare, as the data starts to soften through Q1 for other reasons. That's when you get into a difficult spot, a much more difficult spot as well.
I mean, nobody wants to hear this, but it's simple. Corporations are going to adapt. I think you're going to see a feeding frenzy, John, in selected parts of technology where people are really going for scale and going for market share. You can carry that over to other industries that indirectly use technology.
You think the Microsoft story, Tom, a taste of things to come? Even with the regulatory issues down in D.C.?
I think it's unfair to blanket Apple or Microsoft over the rest of the corporate world. Those are profit juggernauts we've never, I'll say basically we've never witnessed. Maybe we can, witness it in shipping in Britain in the 19th century. But John, what I would say is we underestimate corporations' ability to adapt.
That was your call last year, Tom, and we saw some big returns as corporations adapted in a big, big way. Rob Rosner. Why do I keep calling Rob Krosner?
You're killing it. I'm surprised he may not come on.
I'll apologise to him in the break and on air. Robert Rosner, the senior US economist at Morgan Stanley, coming up shortly. Futures down 0.4%. On radio, on TV, for our audience worldwide. This is Bloomberg.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Sydney. In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
Honestly, never mind the Bramo camp. Just keep the mics hot for the commercial break. Some of the stuff Tom comes out with. Futures down 16, and he keeps a straight face. We're down 0.4% on the S&P. On the Nasdaq 100, we're unchanged. In the bond market, your 10-year yield up 4 basis points to 181.24. This from Morgan Stanley and Mike Wilson over the weekend. The safety net of forward guidance from the Fed is gone, just as earnings revisions and PMIs appear set to decelerate. Goes on to say, an unattractive risk-reward setup. Bramo has not edited this piece. I'll keep reading. We remain sellers of rallies and of the view that the S&P 500 fair value remains closer to 4K tactically. Stick with defensives under the hood. The call, Tom, from Morgan Stanley on the equity side, lining up with a call from Morgan Stanley on the Fed side, interestingly, increasingly more recently.
I'm so glad, John, you bring this up. And folks, this is what makes it fun for us. We show up here every Monday with a great team that frankly works through the weekend. And the difference of opinions that we're seeing at any time, and particularly right now, is extraordinary. The other issue we have is Mark Crumpton, the acclaimed Mark Crumpton, keeps a list of guest names that I've mispronounced over the years. Pharaoh catching up. And this, of course, is the folk duo Krosner-Rosner. They were great. I loved what they did in the 70s. Neil
really
Young.
Good, Tom.
Krosner-Rosner has left Spotify. That's what we got, John.
Why did they leave Spotify, Tom? They are happy about
COVID misinformation.
The misinformation that comes from the Joe Rogan podcast.
I think so. Krosner-Rosner went down in flames just as you have, pronouncing Robert Rosner's name.
Rosner of Morgan Stanley, okay? He joins us next.
He joins us right now. Robert Rosner, senior U.S. economist here at Morgan Stanley, joining us this morning. You stop when you see a research piece, folks, that is carefully considered. I did that last week as Rosner, Zentner, and the team did a terrific essay on our fiscal debt. Robert, congratulations on the essay of R minus G. Just really simple here. Do you have confidence that we can generate a growth rate to pay off this fiscal morass?
Well, thanks for having me, Tom. You know, that it's an important point because we saw debt to GDP ratios rise very significantly last year. And of course, that was driven by the fiscal deficits that we saw in both 2020 and 2021. But coming out of this year, our projections for public debt relative to GDP are actually set to come down. Now, they're not set to come down all the way, but it does evidence just how much a very rapid rate of nominal GDP growth can do to actually dent into those debt projections.
The gloom crew will use that as a tool to say it could adjust Fed policy. Can a fiscal debate or fiscal dynamics change Fed policy?
Well, fiscal matters for the Fed right now in as much as it actually impacts the real economy. Fed policy right now is not being driven by the state of fiscal policy, but really about the state of the economy. And so it's really the economy, real activity, and inflation that are in charge when it comes to driving Fed policy.
Rob, you're at 4 for 2022. You say the risk now is that they do more, together with Ellen Zentner and the team, following the economics. Can you tell me what's the more important risk for you at the moment? That they front load some of the hikes you've got priced, or it's what they do later this year into 23? What are you more focused on?
Yeah, well, look, John, this is a very data-dependent Fed. And of course, we heard about 1 million times from Chair Powell, it has to be a very nimble Fed. It's going to be guided by the data. And given the backdrop of inflation, that will take a number of months to really see significant sequential slowing that we're expecting. That puts a lot of focus on the incoming data. And given the Fed's positioning right now, it certainly raises the risk that we could see the Fed front load the rate hikes that we are anticipating. But what is really important is that this is not a Fed that's committing to forward guidance. And so it's really going to be the data that's in the driver's seat, and particularly the inflation data that's in the driver's seat, that's going to determine how fast, how much, and to what level we end up settling on the Fed funds rate.
And Rob, how that data on the inflation side is offset potentially by what happens on the growth side with the PMIs, with the output numbers. Rob, are you anticipating now as a base case that they hike into weakness? What is the base case for you on that side of things?
Well, our base case is certainly that they're going to raise interest rates for the first time by 25 basis points in March. There were two things that the Fed was clear about last week. It's that they are gearing up for that first rate hike in March, and they're gearing up to start the process of QT sometime thereafter. Now, that is happening against a backdrop of first quarter growth that looks to be dampened. We started off our growth tracking for the first quarter at just a 1.5% annualized pace. GDP in the fourth quarter, as we know, came in closer to 7. So that's a significant sequential step down in the pace of growth. But the Fed has given really good reason to look through that, and really given good reasons for why they're looking through that. In particular, there's some messiness from Omicron, of course, that's overlaying the trend for the quarter. And coming out of the year, we saw that weak retail sales report that set a very weak base effect for first quarter growth. So the first quarter numbers from the activity side are looking a bit softer, but you've really got to zoom out and look at the fundamental story. How long is this first quarter growth slowdown going to last? And from the medium term perspective, we still remain constructive on growth. So we got to get through this first quarter softness, but the balance of the year to us still looks like it will come in fairly solidly.
And it seems like the Fed, Robert, agrees with you and probably will look through this, and that seems to be the bet from a lot of the Wall Street firms. I want to go back, though, to what John was quoting from Luke Kawa over at UBS, this idea that this is not a growth scare that we're seeing in the market. This is a valuation-centric sell-off. At what point does a valuation-based sell-off become a growth scare, become exactly what the Fed is trying to orchestrate, which is slower growth and some sort of easing in the inflation?
Yeah, it's all about financial conditions and how much do we need to see financial conditions tighten? Because, of course, very connected to what we're seeing in markets is what is the objective of the Fed here? And we've heard from a number of Fed policymakers, including Chair Powell, that given the backdrop of shifting Fed policy, it's appropriate to see some tightening in financial conditions. By our estimates, by our forecasts, that's actually set to continue. And rather than being a source of concern right now for growth, it's almost a desire for the Fed to get those conditions snugged up a little bit, because on our measures where we are right now, the state of financial conditions, the level of financial conditions, while it's tightened on the margin, is actually still net supportive for growth. So FCI still accommodative. You have the Fed noting that in their statement as well. That means there's some further room for financial conditions to tighten here before we get close to even a place where financial conditions are more neutral for the growth backdrop. So bottom line, this is about financial conditions tightening in response to Fed policy, but there's more room to go before we actually see it becoming a material growth risk.
Which goes to the point of, can the U.S. go it alone, right? I mean, is this a Fed story or is this a global story where if you start to get a tightening cycle on a global level, you'll start to get the global rise in yields that will allow financial conditions to tighten the way that the Fed wants to see? I mean, how much are you looking for that magnifying effect by this sort of global tightening that we're expecting?
Yeah, it's a very important trend. I mean, when we speak to our colleagues across the Morgan Stanley Research Department in economics, there are a number of central banks that are moving towards tightening, and even echoing what we're talking about with the Fed, banks like the Bank of Canada or the Bank of England, where we're looking for policy to be tightened now in a more front-loaded way. So there is a little bit of a global theme there. There's definitely idiosyncratic stories elsewhere, but that's certainly an important theme that's going to be driving financial conditions tighter. But we've absolutely seen in the past that the Fed can move financial conditions on its own. It just matters what lever is going to be moving financial conditions. Is it risk markets? Is it the dollar? Or is it rates?
Robert, what is the latest math from your desk on the reversal of goods inflation? Can you game that, or do you just have to wait and see what happens?
We are expecting that goods inflation does start to turn the corner, particularly as we're moving into the middle of the year. So what we've seen so far in terms of our forecasting is that sequentially, we're getting a little bit slower. We've seen some high frequency data that's pointing to at least a moderation in the pace of increase in things like used car prices. So we're just starting to see what I would call flashes of light at the end of the tunnel. We're not there yet, but there are some leading indicators that are pointing in a direction that we can expect at least some reversal. Our global supply chain index has started to turn the corner. That has shown some lead time with the goods portion of CPI, and other indicators like our surveys of analysts have indicated that the peak of disruption in global supply chains may actually be behind us. So we're starting to see some signals that we could see goods prices reverse in the back half of the year. The key question is, how much do they reverse? Because that's going to play importantly into how much we see inflation actually come down. We're expecting core PCE inflation to end this year at 2.4%. That depends on a big decline in core goods prices. If we don't get that, then there's certainly upside risks there.
Robert, just fantastic to read through some of the research recently. Thanks to you and the team for that. Robert Rosner there of Morgan Stanley. Thank you.
Rosner.
Very much. Rosner, looking ahead to the ECB and the Bank of England on Thursday. David Goodman and Lizzie Burden out on the Bloomberg today, Tom. We're looking at the prospect of the first back-to-back hikes from the Bank of England in 17 years. You've got to go all the way back to 2004. It's been a while.
I must admit, John, it is so unusual for you to say that. I really don't know how to comprehend that. And my gut reaction is, can the island nation withstand that? I guess is my gut reaction. We don't know.
Joining us that Thursday, Tom, I believe, and the team will get in my ear and tell me if I'm wrong, Danny Blanchflower is going to be joining us this coming Thursday.
He's fired up.
He joined the MPC 2 years after that.
Yeah.
He is fired up.
They're fired up.
Not just on the Bank of England, but on the Fed too. He does not see a reason to hike right now.
His colleague in crime, David Rosenberg, up in Toronto, just reaffirmed growth slowdown. I mean, he's saying, look, the slowdown's here. There's just the opinions are just extraordinary.
He's looking at the confidence numbers, and let's be clear about this. Lisa, on Friday, consumer confidence sentiment from you, Mitch, not pretty.
Unless there's a sea change in the economy, the argument here is that inflation is a constraining effect. People will reduce their purchases unless they're getting huge wage booms, which they're not. Real wages still deeply negative.
No one jumped in my ear to tell me Danny wasn't joining us Thursday, so Danny's joining us Thursday. Looking forward to catching another man from Dartmouth College. He says the Fed should do nothing. Laurie Heinel, the Chief Investment Officer at State Street Global Advisors, preparing for this Fed to do something. We'll talk about the equity market a little bit later in 20 minutes' time as we count you down to the opening bout. From New York City, this is Bloomberg.
Promotion.
With the First Word News, I'm Ritika Gupta. Several developments in the crisis in Ukraine. The United Nations Security Council will debate the issue today, and the Pentagon says that Moscow has increased the number of troops that have been deployed along the Ukrainian border. Russia's President Vladimir Putin says he has no plans to launch an invasion. Atlanta Fed President Raphael Bostic says the central bank could do a half-point interest rate hike in March if needed to fight inflation. In an interview with the Financial Times, Bostic stuck to his prediction that the most likely scenario is 3/4-point increases this year. The Fed typically raises rates in Financial Times. Bostic stuck to his prediction that the most likely scenario is 3/4-point increases this year. The Fed typically raises rates in quarter-point increments. The United Arab Emirates is about to shed the tax-free status that made it a magnet for businesses around the world. The government will introduce a 9% tax on business profits starting a year from June. The tax will not apply to personal income from employment, real estate, and other investments. And Mexico has fallen into recession. The economy declined 0.1% in the fourth quarter. That follows a 0.4% contraction in the third quarter. Mexico is one of the world's largest exporters, and it's been hurt by those global supply chain problems. And Spotify is trying to end the controversy over misleading coronavirus vaccine information. Star podcaster Joe Rogan has pledged more balance and better research for his shows. Singers Neil Young and Joni Mitchell pulled their music from Spotify last week to protest Rogan, who has hosted outspoken critics of the vaccines. Spotify will also add content advisories. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is larger in scale and scope and the massing of forces than anything we have seen in recent memory, and I think you'd have to go back quite a while into the Cold War days to see something of this magnitude. They do annual exercises, and we watch those closely, but this is different.
The gentleman from the Joint Chiefs of Staff, General Milley, there with an update here, and of course many updates through the weekend, as the message is managed in Washington, and the message is managed in Europe as well on Russia and Ukraine. Right now, a great honor for Lisa Bramwitz and I to bring to you on radio and television across this nation someone who viscerally understands this story. As we spoke to the ambassador of France to the United States last week and his history of Eastern Europe, so too George Friedman of Budapest. He is founder and chairman of Geopolitical Futures and has a family that has viscerally living near Russia. George Friedman, what does the media, what does the analysis get wrong about Vladimir Putin?
Well, he wants Ukraine, but he did something very strange. He did not attack weeks ago. You don't launch an attack without surprise if you can get it. And sitting there waiting for the United States to build up its defensive capabilities, which the U.S. has done, just increases the chance of losing. So right now, he's not going to invade Ukraine. He's really looking at how to split NATO.
Within splitting NATO, and this is Angela Stent writing in Foreign Affairs this weekend on the Putin doctrine, I guess I have to ask, what is the Putin doctrine that you see that will allow for a split, a fracture of NATO?
Natural gas. Russia is supplying almost all of Germany's natural gas. The rest of Europe too, but Germany is the key. It's the big player. If Germany joins with NATO, it risks having a Russian cutoff of natural gas. If, on the other hand, it doesn't, it goes against the grain of both the United States, the British, and other players, particularly the Eastern Europeans. So what I think Putin is really doing is creating a situation with his hammerlock on natural gas, where the Germans are in an impossible position and are likely to go and split from the West in resisting the Russians, or at least to the extent of not cooperating in building a defense.
George, in other nations, we might ask about popularity. Does it even matter here whether this move that Vladimir Putin is embarking on is popular among the rank-and-file Russians?
I think at this point, in near-war situations, popularity doesn't matter anywhere. You notice in the United States, everybody's quite quiet about it. The Germans are, on the whole, opposed to any operation. The British are very deep into it. Each one of them is following their national interest. And the decisions are going to be made soon, very quickly, very rapidly, and I don't think public interest will affect it, except that no one wants to come out of this looking like a loser. It's how you come out of it that matters.
Well, so how does Vladimir Putin look like a winner from all this?
Well, at this point, he appears to be a winner because the West has gone up and gotten really alarmed. So already he shows the Russian people that they're taking this seriously, which we really haven't. The second step is, however, he's got to do something. An invasion is a very risky thing. You can lose, and he cannot afford to lose. On the other hand, you're in a situation where if he can manage to split NATO, if he creates a crisis in NATO, he can do something, which is why the United States right now is scrambling to find natural gas sources that they could send to Europe to support them, because that's where the key is. If he doesn't want NATO to advance into the East, A perfect way to do that is to split NATO wide open on the natural gas issue.
Well, George, this is important, and this goes back to your work at Stratford and, frankly, your academics at Cornell before that. Is it feasible to salvage Europe with the delivery of hydrocarbons? Have you ever seen a study where we can deliver to Germany and the rest enough oil, gas, and the rest?
What I have seen is that it can't be done. There's not enough bottoms to do it. But at any rate, the United States has to give it a try, has to make it clear to the Europeans that we care about this situation, that even if there's going to be an interruption, it will be a short interruption, and we'll be able to handle it, and so on. But the problem, what Putin has done very well, is to shift the burden over to the Germans in particular, the Europeans in general, where the choice between defending Ukraine and having their economies wrecked has to be made. And whatever public opinion now comes in, they're going to go, Ukraine's not that important to them.
Is it a generation?
That's how he wins Ukraine.
Is it a generational shift of a new German government? After Merkel, does that matter in your analysis?
Well, Germany has built an economy that's really very powerful in Europe. It is a leader economically in Europe. Without natural gas, it doesn't have that economy. It's built itself into that position. The U.S. should have perhaps tried to build alternatives years ago, but it didn't. So it let this situation develop, and now it's playing out. It's really a reality that can't be ignored.
George Friedman, thank you so much. Greatly appreciate it with Geopolitical Futures today. Just authentic analysis there. One perspective on our international relations. Lisa, very quietly here, I know DXY out to 97. It's just one of the quiet stories here has been continued dollar strength this morning.
And this actually is a perfect way to link the beginning of this show with the end of this show. Russ Kostrich of BlackRock coming out and saying that actually betting on the dollar and betting on cash are some of the best risk-off hedges right now at a time when there is so much potential risk in benchmark bonds. And to me, how much does that continue to be the trade as the Wall Street analysts get ever more hawkish with respect to Fed prognostications?
Yeah, and do we agree that to me the hawkishness, I'm really sort of taken aback by it. I get 4 rate increases on a measured basis is just 1 percentage point. I get it's not all that much within the scheme of it, but I'm just still surprised at the certitude out there of gaming the parlor game out.
Well, you said it this morning, the Washington Post story talking about 14% increases in rents in certain cities around the country. This is becoming a political problem. This is becoming an economic problem, particularly for the lower income individuals. The Fed has to get ahead of it, and they've already talked about that, and they want to present a shock without it being too big of a shock, which is a dance they haven't done for decades.
But what to me is interesting is, say the Post is wrong on Redfin, I believe is a source, is wrong on 14, split the difference. Is 7% rental inflation acceptable to 2/3 of America? The answer is absolutely not.
Especially because wages are not keeping pace, right? And what you're seeing is they're falling further behind. And you have, I believe, a negative 2.3% real wage rate in the U.S., right? How does the Fed deal with this at a time when it looks like the employment market is pretty tight?
I'm going to be on the edge of informed here, folks, and go to ECO Go. This is how Bramo does it. I mean, you sit there and you go look at the secrets, the trade secrets of East. And I got ISM tomorrow, Lisa. I'm sorry. That's a first look. That's important.
Yeah, it's important. Also, JOLTS this week is going to be really important, the job openings.
Favorite.
And of course, the payrolls report on Friday, not to mention the Bank of England and the ECB. Fascinating.
Oh, are they this week as well?
Thursday, yeah.
I did not know that.
Yeah.
That will be interesting to say the least. Futures -10, a churning to the market, a roiling to the market. NASDAQ 100 shows some green on the screen as well. Stay with us. Ambassador Haas, the 12 noon hour.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Can we close out January already? Let's do it now. We've got one more day of it from New York City this morning. Good morning, good morning. Your equity market slightly negative, down 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York, we begin with the big issue. It's just one big guessing game.
As we approach that March meeting,
all options are on the table.
We have seen a massive migration up in expectation for rate hikes.
We start to hear talk of 7 interest rate hikes this year.
The center of gravity is now 5.
If inflation stays stubbornly high, maybe we get 7 or more rate hikes this year.
We have Bank of America at 7.
We seem to be in a race for who can come up with the biggest forecast for number of rate hikes.
There's been some rumblings, even a 50 basis point move coming out of the gate.
A 50 basis point hike in March.
I don't believe in a 50 basis point hike in March.
The question is, does the Fed have to tighten the screws more than that?
Who knows?
It'll depend on what happens with the inflation environment.
There's a lot left to be determined. We're, walking a tightrope here.
Let's start the conversation with the panel. State Street's Laurie Heinold, John Hancock's Matt Miskin, and Greg Staples of DWS Investment Management. Laurie, let's begin with you. I want to start here. Have we fully discounted this story yet? Have we done that yet? 4, 5, 6, 7?
Well, it's a little crazy that we've moved from, being skeptical about whether the Fed would move at all to now some prognosticators thinking that might be like 7 interest rate increases. We actually think that the Fed is going to retain a lot of flexibility. And while some may have read Chairman Powell's remarks last week as hawkish, we actually thought that they created a lot of balance, that he's going to continue to evaluate the risks. He's going to continue to evaluate how the inflation trajectory is evolving. And we actually think that they're unlikely to go even the 4 that they seem to be committed to.
Capital economics think it's limited to 4. Matt Miskin, I think this might resonate with you. It's about the growth slowdown. They say Powell fueled fears of rate-mageddon with a hawkish performance, but even with both wage and underlying price inflation running at near 40-year highs, disappointing real economic growth this year will limit the Fed to 100 basis points of tightening. Matt Miskin, does that resonate with you, sir?
100%. Yeah, and we agree with Lori as well. And really what we're seeing is the yield curve is disagreeing with the Fed. You know, the Fed could say they're going to raise rates, they're going to be as hawkish as they want, but if the 2-10 spread is now 60 basis points, that gap is closing fast. And the more they pull away growth and growth decelerates, we think just from inertia, you know, fiscal cliff, higher short rates, oil prices up, all this is going to weigh on economic activity. And our view is that they're going to actually balk and do more or less around 4 hikes, perhaps 3 actually, and come in a little bit soft.
Greg Staples, you're not convinced by this at all. You've called the pivot plastic hawksbill, plastic talons. You don't think he's a hawk at all. Why?
Jonathan, you opened up by asking if the market's fully discounted this. I think market professionals are now digesting the great Powell pivot, and I think it may be market professionals that were behind the curve a little bit and are now catching up and haven't hit their spot. Listen, data through the first quarter is likely to be checkered and inconclusive. The decision framework going forward gets even more complicated. Sequences of strong and then weaker data are the nature of this recovery. We're seeing some weakness in ECI last week, softer consumer spending. You know, this Friday's jobs number potentially even could be negative. So we think that there's potential for, obviously, clearly 25 basis points in tightening in March, probably 2 or 3 more as we go deeper into the summer. But after that, it's quite likely that the Fed pauses a bit and sees what the implications are for the overall market.
Some people talking up 50 in March as well. This was the quote from Raphael Bostic of the Atlanta Fed. He spoke to the Financial Times. Every option is on the table for every meeting. If the data says things have evolved in a way that a 50 basis point move is required, then I'm going to lean into that. Mike McKee, and if the data doesn't say that, then I guess he won't. I mean, isn't that the takeaway from all this? They're ready to go, ready to do whatever they need to, depending on what the data says.
Yeah, they don't know what they need to do. We don't know if Raphael Bostic is the first in a group signaling that, yes, 50 basis points is coming. But if you look at the phrasing, he said if. He doesn't know. The Fed doesn't know. And you look at the number of rate hikes, the wide dispersion there from Morgan Stanley on one end to Bank of America on the other end, and Wall Street doesn't know either. Here's the Bank of America case. They argue that the Fed, through Jay Powell, all but admitted it is seriously behind the curve. Risks remain that could push up inflation, including more China lockdowns that would affect supply chains, labor shortages, and there is the possibility of a dock workers strike this summer. You've also got energy prices going up, geopolitics, and U.S. politics on the calendars ahead. What the Fed doesn't know, however, is what's going to make the big difference. First of all, Omicron. You notice that we only have 150,000 jobs forecast for Friday because of Omicron interrupting the economy in January. Or do we get a new variant? Fiscal support going away. The government isn't sending checks to everyone anymore. And then the market is raising rates. Are we going to see a change? Big change in mortgage rates over the last week or so. Pending home sales fell. Do we see that continue? We'll get auto sales tomorrow and see what kind of impact rising rates have on that. So, John, a lot out there that's going to happen between now and the end of the year that nobody can really say what it means.
Mike McKee, thank you, sir. Looking ahead to payrolls, I want to pick up on payrolls. I want to pick up on the work of Bank of America as well. B of A and Ethan Harris made a ton of headlines this Friday. They said this: the Fed has all but admitted that it's behind the curve. We now look for 7 hikes, 25 basis point hikes, 7 of them this year, and a peak in the Fed funds rate at 2.75 to 3. Further down the note, this is the interesting part, they're also looking ahead to payrolls and looking for this. We expect non-farm payrolls contracted by 150K in January, owing to the shock from the Omicron variant, while wages pop month-on-month 0.6%, year-on-year 5.3. Laurie Hino, I want to come to you on this. There's a bank looking for 7 hikes, also looking for a contraction on payrolls on Friday. Are you just going to look right through whatever that payrolls number is this Friday?
Well, this is really the conundrum. We're likely to have mixed economic data over the coming months. Certainly, Omicron is weighing on markets heavily. We're also likely to see supply chain shock. So it's unlikely that the Fed is going to have an all-clear signal to do something dramatic. So we think that's why they're going to move a quarter point, not 50 basis points or more. But the other important thing is that this trajectory is going to evolve. And we think the second half of the year is going to be quite delicate. And we may be in a situation where the Fed still feels compelled to tighten even while the economic data is actually rolling over. So again, we think that they're going to be more cautious. They're going to be data dependent, but the data is going to be mixed. So they're going to have to make some judgments here.
I was going through some UBS research this morning, Matt Miskin, and it was about whether we were going through a growth scare right now or whether this was a value Valuation-centric sell-off. The line read like this from Luke Carr and the team. This is not a growth scare. This is a valuation-centric sell-off. It goes through what's happened with real yields and why the market's got to adjust. We get all that. But Matt, what happens when you start to conflate a valuation-centric sell-off with a growth slowdown because the numbers start to look like they're heading in that direction? We've seen one piece of this. Do you think we'll see both and sometime soon?
Yeah, right now the market seems to be looking past the economic air pocket we're developing because Omicron is already putting all its chips on this reopening trade or this reopening development. And we think that's, we wouldn't overemphasize that. We think we do come back after the Omicron wave, but we think the comeback's not going to be as stellar as the past couple ones, and that we don't have stimulus checks. We don't have everything else as tailwinds. We think it's going to be more sluggish growth. And I guess another twist to that growth scare dynamic, let's take a look at the Russell 2000, the small cap index. It just dropped off of a support line that was really important. It's down, over 10%, and 50% of the U.S. economy is small businesses. The Russell 2000 small caps being under such pressure, that's a growth story that is not aligning with that narrative right at the moment.
Russell futures softer this morning, down another 0.6%. The S&P just a little bit lighter too. The Nasdaq 100 firmer, about 22 minutes away from the opening bell. Greg Staples, a lot of people come on shows like this and say soft landing. The Fed's looking to engineer a soft landing. How would you define success? What is a soft landing? What does success look like, Greg?
I think it's going to be extremely difficult. I think a soft landing is probably a situation where asset prices don't sell off considerably. You're talking about unemployment in the 3.9 to 4.2% range, and longer-term inflation back to where I think the market's expecting it to be. Think 2.25, 2.5%. And the interesting thing is, if you look, for example, at five-year forwards in terms of break-evens, still 2.10%. If you look at 2.1%, if you look at break-evens on 10-year tips, still 240, 250. You even look at the terminal rate. Right now, we're talking about 1 3/4. So it seems as if the market's expectation is we'll get through this. The Fed will engineer a soft landing. But boy, it's going to be tricky getting from here to there.
Laurie, just a final word as you sit around the table with the team at State Street, in person or virtually, at the moment. How is that conversation going, Laurie? What is the end point for you, the destination here? Is it a soft landing or something trickier?
It's definitely something trickier, and we've been taking risk off the table because we do think it's going to be a little bit challenging for markets to navigate this as well as for the Fed to navigate it. We do think we come out of this at structurally higher inflation rates and probably structurally higher interest rates, but we also don't think that the Fed's going to move aggressively to curtail that inflationary pressure.
Tons to get through today. Great lineup to do it with. Laurie Heinel, Matt Miskin, Greg Staples sticking with us. Coming up on the program, inching towards an agreement on Russia sanctions. We'll get to that in a moment. Need to get you some stock movers too with Abby.
John, let's take a look at the shares of Citrix Systems. Surprisingly, they are dropping. Well, maybe not so surprisingly. They are, of course, being bought out by Elliott and Vista, but it's the price that has the stock down. They're buying the software company, the stay-at-home software company, for $13 billion or $104 per share. That is below Friday's close, which was above 105. You can see the stock is closer to 102. The deal is not surprised. It does represent the first big leverage buyout of the year. The super interesting thing here, John, beyond the fact that they're saying it will be the largest software provider with 400,000 customers, this stock peaked back in July of 2020 with a market cap of close to $21 billion. Again, now it's going for $13 billion. Really a sign of the stay-at-home trade.
Abby, thank you. Coming up next on this program is the Senate, Congress united on what to do about Russia.
There's bipartisan support to sanction Russia. Now, I will just say this to President Putin. If you invade the Ukraine, you will destroy the ability of future presidents to treat you and Russia as normal.
That conversation up next. This is Bloomberg.
Did Delta fundamentally change the sort of infrastructure of hospitals and medicine generally in India, or was this just a short-term phenomenon and things reverted back to the mean?
So it did change. I think from a preparedness standpoint, how the hospital infrastructure sort of geared up for it, and whether it was oxygen requirements. I think most hospitals have put up liquid oxygen plants, temporary plants. Some have put up permanent plants. I think the capacity for oxygen and other, medicines and supply chain has been augmented, enhanced. So from that standpoint, I think there's been expansion in capacity in infrastructure. We've all sort of seen how far we can stretch the envelope.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Earnings season is here.
It has been brutal.
A little bit of disappointment in some of the early reporting.
Bloomberg is fastest with the numbers and analysis.
This is a mighty crash.
What to buy and what to run away from.
Bloomberg, the fastest numbers and analysis you trust.
We've been nothing but clear and transparent about our concerns here at the Pentagon over this rapid buildup over the last few months around the border with Ukraine and in Belarus, not to mention, maritime activity by the Russians in the Mediterranean and the Atlantic. Putin has a lot of options available to him if he wants to further invade Ukraine, and he can execute some of those options imminently.
Can the administration get Congress on side? It looks like they can. US senators closing in on a Russia sanctions bill, while UK counterparts weigh targeting, quote, any individual or company of direct interest to the Russian state. In response to that threat, the Kremlin coming out with a statement saying the following. These are very alarming statements from London. Not just for us and our companies, it demonstrates London's unpredictability. What we're talking about here is a blatant attack on business. President Putin has continually denied plans to attack Ukraine. Down in D.C., Bloomberg's Anne-Marie. Hi, Anne-Marie.
Hey, John. Well, you and I both know there's a reason why they call London sometimes Londongrad, and the UK really wanting to take aim at some of these oligarchs that have ties to President Vladimir Putin. And here in the United States, there is bipartisan support certainly drumming up in terms of sanctions against Russia. And we saw that on the Sunday shows on CNN. A Democrat and a Republican senator, Senator Bob Menendez and Senator Risch, coming out together talking about this effort in terms of these sanctions. And it's going to be a two-prong approach in what this legislation would be. First, it would have sanctions on Russia right now. And this has to do with actions Russia has taken to undermine Ukraine's government in general, in terms of also false flag operations, as well as cyber attacks. And then second, there would be these sanctions that would be penalize Russia if they were to invade Ukraine. This would be very harsh sanctions against the financial sector specifically. And then there's one issue they're still debating, and this would be Nord Stream 2. There's a little bit of a difference here on how they both want to approach Nord Stream 2. But Senator Menendez says, Jonathan, they are on the 1 yard line. So you can expect a lot of talk on this upcoming week.
Let's stay on the energy piece of this just for one further question. AMH, the president today leaning on an ally maybe to help out the Europeans. How's this going to work?
Yeah, this came out from first our reporting, me alongside Jennifer Jacobs, that they were in touch with Qatar, which is a leading LNG export, to potentially help fill a hole or a gap if any flows from Russia were to be hit in terms of gas exports, specifically to Germany, which is very reliant on that Russian gas. But Qatar wouldn't be enough. And the issue that Doha has, they have long-term contracts with mostly Asian customers. So the U.S. is also engaging, Jonathan, a number of other countries. It would be a number of countries and a number of exports that they would have to divert to Europe in order to fill this hole. But we should note that this could not be a long-term solution. This would be probably a short-term solution. And also, this is just an in case, right? This is a problem that they might have. It doesn't mean they're going to get there just yet.
Anne-Marie, thank you. AMH, down in D.C., finishing down the crude side of the story. This month could be the strongest January in nearly 3 decades. A month of gains up 16, up 17% on crude. WTI this morning up again. Brent up again to 91.16. We caught up with Chevron CEO Mike Wirth about the potential for triple-digit crude.
You know, $100 is certainly, you know, within the realm of what we could see in the next few months. Longer term, we think markets rebalance and prices will moderate.
Back with us, Laurie Heinel, Matt Miskin, Greg Staples. Greg, we talk a lot about the inflation dynamic, the Fed's response to it. Yet every single day, I've just got this one eye on what's happening with crude. In the 90s on Brent, keeps climbing on WTI. Greg, what do you make of that dynamic?
So listen, inflation is both cyclical and COVID-induced, and obviously the prints right now are quite high, and it's obviously a challenge to disentangle the two. I think as the COVID recedes and the supply chain and labor force participation picks up, as crude oil, new crude oil comes onto the U.S. production, I think we'll see some easing in the price there. So it's really that is more of a temporary situation. I think that the reaction of inflation to tighter money also is going to be delayed, and that's more complex and indeterminate. So the Fed does not have a dial that moves rates up and moves inflation down. I think right now, though, the passage of time is going to be their friend. And as we open up the economy from the Omicron going into the spring, some of those inflationary pressures that are COVID-induced are going to ease.
That's the hope, that the calendar might be on their side, on the side of this administration as well. The hope for some people in the White House. At the same time, rents kicking higher is the focus for a lot of people I know. For David Costin over at Goldman, focused on what real rates would do to the S&P 500 and the continued shift higher, perhaps. He also said this too: we recommend investors focus on quality and the potential upside that oil prices should drive for energy stocks. Quality is often rewarded alongside tightening financial conditions. Laurie, can I come to you on that? Energy, quality, alongside what the Fed might do. Does it make sense?
It does. And quality has been a factor that we've focused on for a very long time, because those companies that can be more resilient, that can position themselves against a variety of economic outcomes, are those that tend to do well over time. But I want to come back to this oil problem, too, because it is going to calibrate in terms of the print year over year. But we do have a likelihood of increased global demand against the backdrop of now potentially, you know, some Russia saber rattling, as well as potential that they can't ramp up oil production as quickly as they once could.
I want to bring you in as well, Matt Miskin, to the oil side of the story. In your note, just reading it now, crude up, dollar stronger, the U.S. equity performance versus the rest of the world is curious for you, Matt. Why?
There's a lot of dislocations right now, and the regime, the macro regime, which we try to focus on to make asset allocation decisions, it's all over the place. You know, yes, you have a higher oil price and a higher dollar. That's usually unlikely. You usually get the two moving in other directions. You've got cyclical equities doing well. You've got quality really underperforming, even though, you know, economic data is coming in worse. You know, these dislocations do create opportunities. You got to lean into them. I think what's hard right now is that it's almost a stagflation environment. And January cash was one of the best performers. And, you know, I think right now you have to see who's going to win this battle between the equity side down and the bond side down. Someone's wrong in that fight. We'd lean into quality after the sell-off, both on equities and bonds, and pick out some opportunities for the rest of this year.
Matt, those opportunities, I want to understand, first of all, this stagflation call. Walk me through it. I'm looking at the ECFC function on the Bloomberg. These aren't my views, just putting together the consensus on Wall Street, and by all means push back. Consensus is 3.8%. That's the median, to be precise. The median call for US GDP growth in 22 is 3.8%. When you say stagflation, what do you mean by that, Matt?
I mean, oil prices going up and detaching from the fundamentals. So I don't know, anecdotally, you look at the TSA throughput right now. You look at airline travel, it's fallen off a cliff. You look at gasoline demand more broadly in the U.S. right now. Because of Omicron, it's lower. And yet oil prices are going up. Look at the Atlanta GDP now. So I know 4%, you know, as the forecast for the year. Atlanta GDP now for Q1 is basically zero. The economy's stagnating, and yet oil prices are going up. To me, that's a dynamic where inflation at the pump right now, you're getting higher prices, and yet the economy's stagnating. I'm saying it's a pocket. I don't want this to continue. I mean, that's a personal thing, but also just looking at this, you know, we want this dynamic to end and for other asset prices to take leadership. But this geopolitical risk is throwing a big wrench in a lot of this developments for the economy and inflation backdrop for the near term.
As I read out that 3.8% number, Jan Hatzius of Goldman Sachs has just cut his forecast for GDP in America. On an annual basis, GDP forecast is now 3.2%. The 3.8% is the consensus I talked about, the median estimate in our survey, so down to 3.2. Laurie, does 3.2 get it done, if that is indeed the number, or does the direction of travel, is that the thing that really matters here for you?
Well, first of all, we don't think 3.2 is the number. We think it's likely to be quite a bit higher than that. But even 3.2 would be well above trend, which is more in the low twos. So either of those scenarios really looks at an expansion that's above trend and one against which risk assets could do okay.
Laurie Heinel, sticking with us alongside Matt Miskin and Greg Staples. We'll keep building on this. A ton of research over the weekend. Morgan Stanley and Mike Wilson. Very, very bearish. We're going to talk about that around the opening bell. Coming up, the morning calls and later, volatility remaining elevated ahead of another busy week of earnings. That conversation still ahead from New York City on the month. On the month, it's been ugly, and we're off the lows. That's the good news. We're down 7% on the S&P, down a little more than 11% on the month so far on the NASDAQ. This morning, S&P 500 futures negative 14, down 1/3% from New York. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Minutes away from the cash open, the opening bow just around the corner. Equities just a little softer, lower, negative, down 1/4% on the S&P. On the NASDAQ 100, still positive on the day, very much negative on the year so far. That's the equity story. Let's get you to the bond market as well. We look like this on twos, pushing higher by 3 basis points. Year to date, up almost 50 basis points. What a move that speed at 119.46 right now. That's the price action. Let's get you some morning calls, shall we? First up, Credit Suisse upgrading Tesla to outperform, seeing an attractive buying opportunity for a growth stock with solid fundamentals. BMO downgrading Kellogg to market perform, the analyst pointing to ongoing supply constraints and cost inflation. That stock down 2.5%. And finally, Citi upgrading Netflix to a buy, expecting shares to rebound given the company's strengthening pricing power. That one has been hit hard and hit really hard very recently, and then hit hard again, up 3.9% in the pre-market. You get the picture. Coming up, another critical week for big tech, Amazon and Google earnings on the calendar, with the NASDAQ heading for its worst January on record. That conversation just around the corner, and so is your opening bell.
prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Excessive alcohol consumption is inappropriate. I mean, that's not a personal message from me to you. Do what you want. That's the message from Sue Gray on Partygate in the UK. If you have no idea what I'm talking about, Guy Johnson's going to join us a little bit later in the programme, hopefully soon, from London, to explain it all. That's happening about in New York. Futures negative 8 points on the S&P. We're down 0.2%. On the Nasdaq 100, bouncing back a little bit, up 0.4%. I'm sure you all want to leave this month behind if you've been long the Nasdaq 100. Switch up the board and get to the bond market. Tens look like this. Yields are up 3 or 4 basis points. The 180.52 on twos. Yields are up big time year to date, up almost 50 basis points. Up on the session a little bit as well. Back through 120 through much of this morning. Euro dollar coming back 111.91, up a third of 1%. The ECB meeting on Thursday. The BOE as well. Crude up 74 cents to 87.61. Let's call it up 80. Let's call it up 0.9%. There's your opening bow. Then back with us, Laurie Heinel, Matt Miskin, Greg Staples. Want to go straight to Mike Wilson at Morgan Stanley. Here's the quote. We remain sellers of rallies and of the view that S&P 500 fair value remains closer to 4,000 tactically. Stick with defensives under the hood is the message coming from Morgan Stanley. Goldman and David Costin put out some research as well on what would happen to negative real yields and what would happen to the equity market off the back of it. I want to turn to that. Valuations have contracted as real rates have risen. That we know. The S&P 500 would decline by 10% to 4K if the real 10-year Treasury yield rose by 60 basis points to 0, by 15% to 3,800 if it rose to 100, rose by 100 basis points, and of course ending all else equal. Laurie, your thoughts on that? The relationship right now between the adjustment we've seen on yields, on real rates to be specific, and the translation effect into the benchmark here in the US. How strong is that relationship at the moment, Laurie?
Well, certainly we've been watching that very carefully. We've actually been lightening up our U.S. large cap positions, and we're now underweight the U.S. large cap in part because of this relationship. But we also think that valuations have gotten a bit stretched. And so we're deploying capital into other areas like European equities and Japanese equities, where we think valuations are more attractive for the rate environment.
Matt, can I come to you on the same question, sir, and then maybe throw in what Laurie just mentioned there about the international exposure against, say, the U.S.?
Well, if real rates go up because inflation expectations come down, that's not a bad thing. You know, that's okay. If that's how we get higher real rates as inflation comes down, that's fine. And I don't think that's going to be a massive re-rating story in some of the U.S. equity market. You know, I think that at the end of the day, it's going to be about growing earnings this year. And it's going to be really hard to do. And we're looking at those companies with higher return on equity, good balance sheets, good earnings momentum, can take market share. And that's in technology. And the highest ROE companies are in the United States. So that's what we're leaning into, and we're not overplaying the real rate story. We think that valuations are going to be, coming down a bit, but at the end of the day, earnings have to grow. We're looking at mid-single-digit earnings growth, and the market's down already 10%. That can give some upside potential after the recent price action.
Interesting. Where would you have those exposures right now in this equity market concentrated, Matt? Where would you put it? Just be more specific.
Yeah, tech. Right now the earnings engine is still on there. Communication services, we got some big reports this week out of that. Healthcare and industrials. So industrials being our cyclical play. But the quality element is going to bring in the technology and communication services, those higher margin businesses. It's a war on margins this year. Everyone's going to be feeling it. And you've got to find those companies that can ward it off the best. Tech can raise prices too. Communication services companies can raise prices too. They're doing it. And they're able to ward off the margin pressure, we think, better than other parts of the market.
It was a war on margins last year as well. They weathered the storm. Margins look good. Laurie, can they weather the storm again?
Yeah, again, we think that tech can do okay in here, but part of the issue is what are the tailwinds that you're going to have? And we just don't think that the U.S. is going to have the same tailwinds. Certainly, we're likely to see an aggressive Fed, as we talked about earlier on the show. We don't think that there's going to be a lot of appetite for fiscal stimulus. And we also think that there are better valuations. And when you look at the makeup of the indices outside the U.S., particularly the European indices, they are more geared to those kinds of companies that could do well in this late-stage expansionary phase. So while we don't count the U.S. out, we actually think there are better opportunities outside the U.S. right now.
Greg Staples, a lot of this leans on your work, where you think real yields may be heading here. Can we get back to zero, Greg, without causing enough pain, without that sell-off being self-limiting and risk assets folding over and people coming back to where they were before in the bond market and bidding things up again?
First off, in terms of quantitative tightening, we can absolutely get real yields, at least on the 10-year, back up to zero. I think that's probably in the cards. But I think what you're talking about here is really the interest rate sensitivity, the interest rate duration, if you will, of big cap stocks. And there is some sensitivity there. I think you could see a turn or two down in PE ratios. But as long as earnings continue to come through, and given our growth forecasts, and I think the growth forecasts I'm hearing from others, 3.8, 3.9%, you're still looking at good earnings growth. So I think that's going to cushion the downside to a large degree of the S&P. I think down to 4,000 is a little bit excessive.
5 minutes into this, we're at 44.30 on the S&P, totally unchanged. On the NASDAQ, slightly positive, up 0.6%, working through one of the worst starts to the year on record. Taking a look at that, here's Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, it's been a really bad start to the year for technology in particular, but for equity markets globally, it has been a roller coaster. I literally have whiplash from the intraday moves we saw last week, some of the biggest intraday swings since all the way back in 2008. And when you look at the NASDAQ 100 in particular, of the 19 trading days we've seen in January so far, 13 of them saw a move to the up or downside of at least 1%. Of course, the majority of those being to the downside, with the index on pace for its worst month going back to 2008. So those swings bringing the VXN, the volatility gauge for that NDX index, out to a 33 handle. In the VIX, the equivalent gauge for the S&P 500 clocked several reads north of 30 last week. And the bond market volatility a little bit more subdued in comparison, but still the MOVE index has been on a higher trajectory as well. And just zeroing in on the bond market in particular, it's not just about bigger moves. There's been a really consistent trend over the last month, and that is a flatter yield curve. You're seeing more dramatic moves at the short end, the 2-year yield up about 50 basis points year to date as the market prices in more and more rate hikes. At the longer end, it's been more muted, maybe pricing in a bit of a policy mistake, concern that growth is going to slow down due to tighter policy. Those two forces together, when you add them up, indicate that the 10-year yield is now only yielding about 60 basis points more than the 2-year yield. John, that is the flattest the curve has been going all the way back to October of 2020.
Kelly Lyons, great work. As always, Kelly, thank you. Looking ahead to big earnings as well. Wedbush's Dan Ives was a bull, he's still a bull. He says this: while the Fed macro and geopolitical issues have created a perfect storm sell-off, the most important tech earnings season in a decade is now the focus of the street, and so far investors like what they see. This week is another crucial test for the battered tech sector. On that, let's get to Abby. Hey, Abby.
Hey there, John. Well, some of the data may not, in fact, support what Dan Ives is saying there, because if we take a look at what's going on, a very interesting trend is emerging as many of the big tech investors have, as many of the big tech companies have reported, and that is lots of growth, beating estimates, but the stock's dropping anyway. The one-day move after some of these great reports has been down 1%. Now, much of that, not surprisingly, probably has to do with valuation. The massive rally over the last 2 years. Not so long ago, the NASDAQ 100 PE on a forward basis, a blended basis, trading at about 30 times, above 30 times, a record high, well above the 10-year average of about 10 times, now closer to levels last seen in May of 2020. But in addition, the growth picture itself is not perfection. You have these stocks priced to perfection, but back in the second quarter of 2021, 87.3% growth. That's just incredible. Analysts for this upcoming second quarter looking at just 4.5% growth. So not an earnings recession, but a massive slowdown, and you are seeing that in some of the stock activity, John.
Abby, thank you. Laurie, you've teased this out a little bit already in the first 40 minutes of the show. Let's end there. Earnings on the S&P 500 and big tech and beyond. What's the call for this year?
Yeah, we think earnings can still be up single digits, sort of 5-6%. And when you add in a little bit of dividends, we see U.S. equities doing okay this year. But again, as I mentioned earlier, we think outside the U.S. is going to be the play.
Matt Miskin, you think they're going to slow? Earnings are going to slow, growth is going to slow. Is that concentrated in one particular sector? Is it right the way through the index? Where is it, Matt?
Yeah, it's more broadly. I mean, it's going to be hard. You know, you're not going to get the tailwind or the flood of capital coming into the markets. You're going to see tightening fiscally, monetarily, and then you're going to see higher input costs. So it's going to be a struggle to find earnings growth. But we do think those companies in the quality side of the market that just got sold off represent the best opportunity for the rest of 2022.
Greg Staples, you're pretty contrarian. You're pretty constructive, and that's what makes you contrarian in many ways. You think credit and risk is going to hold in, the Treasury curve's going to bear steepen. Greg, what's going to drive that?
First off, I think the fundamentals within credit are still pretty strong. You might see some technical outflows, so it could be a little bit of rough sailing for the next month or two in terms of credit spreads. But longer term, credit fundamentals of American corporations are still very, very strong. And remind you, these are the big cap S&P 500s. This is not mainstream America. I think they're far less sensitive to a slowing economy overall. You know, beyond that, it's going to be an interesting summer. I think we've got the confirmation hearings of Raskin, Cook, and Jefferson. They're all superb candidates. That happens later this week. But I think that shifts the center of the Fed to a little bit more dovishness. And I think that you're talking about the ability to accept a little bit higher inflation than 2 to 2.5%. So I think it's going to be a situation where the short end holds here, the long end sells off a little bit more because you're seeing higher inflation expectations accepted by the Fed. That leads us to believe in a steeper yield curve.
Matt Miskin, Laurie Heinel, Greg Staples. Greg, thank you. Just on the yield curve at the end there. Keep going through these Fed calls. 4 hikes at Morgan Stanley, 5 hikes. There's a big group of 5 there. Citi, Deutsche Bank, Wells, JP Morgan, Goldman, Bank of America at 7, BNP Paribas at 6. When you look at some of these calls, just get into the detail of them, where they see those rate hikes actually falling. If you go to Standard Chartered and Steve Englander, they're seeing 4 up front. So they think you go in March, go in May, you go in June, you go in July, and then you pause. They think from there in the back half, this Fed's going to have to confront a slowing economy. And their interesting call, I think, on twos, on a 2-year yield to be specific, they go from 1.1 to 1.6, but they think the 2-year peaks in the middle of the year. They think 1.6% Q2, and by the time you get to the back end, we come back down to, say, Q5, with the risk that this curve inverts. The Standard Chartered call here just gets my attention a little bit more. Coming up on this program, we need to do a ton of things. I understand Guy Johnson's racing to put a suit on, so he can join us on Bloomberg TV just a little bit earlier to walk us through what we're learning in the UK around so-called Partygate. Need to get into payrolls that come on Friday, with some people expecting maybe a negative sign before that number. And we need to talk about China too. The world's second largest economy continuing to lose steam.
The key takeaway from that suite of PMI data that we got for January from China was really that the economy stumbled early in the year.
The latest data out of China up next.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how CFO Luca Zaramella is using local knowledge to help Mondelez grow its global portfolio.
I know our people, I know our customers. We tend to believe that all consumers are equal. They are not.
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron, because as we know, many parts of the world use different types of vaccines, and that would be a great data to look at. It will be also great to look at, because majority of the studies done, uses a small sample number, and most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
If you want the inside scoop, typically Guy Johnson puts the suit on at about 9:55 Eastern Time, then runs to the studio. He's done us a favour. The suit's on right now. You'll be happy to know. Guy Johnson joined us out of London. Guy, we finally had this report from Sue Gray, the senior civil servant, on so-called Partygate. What have we learned?
We've learned that she's not pointing the finger at Boris Johnson, which is the most critical thing in all of this. It is not the complete report, John, because there is a simultaneous police investigation going on, as a result of which Sue Gray is unable to deliver exactly what she learned and the analysis that would go with it. But the fact that it doesn't point to Johnson directly, doesn't mention him by name, is hugely significant. John, it talks about the cultural failings within 10 Downing Street. It talks about a lack of leadership, but it doesn't, as I say, point directly at Boris Johnson. This will give him the green light to make wholesale changes at 10 Downing Street, to be able to have some sacrificial lambs, to hopefully try and make this go away from his point of view. He will therefore likely to survive, at least in the near term. John, what I'm looking for, with the market pricing in 5 rate hikes in the Bank of England, does this have any impact on fiscal policy going forward? At the moment, the indications probably are not. The bigger question, though, I think, surrounding all of this is Boris Johnson may be able to convince Westminster that he can keep his job, i.e. the inner circle, that's kind of inside the beltway, that he should keep his job. Can he convince the rest of the country that he can keep his job? Elections are not on the near-term horizon, but nevertheless, a bigger challenge lies ahead, I think, from Boris Johnson than simply sidestepping this report.
Guy, that's why I think it's pretty interesting that you're bringing up the fiscal issues. Is that something they can do a U-turn on? Will a tax hike, if you don't deliver it, start to feel like a tax cut? You know where I'm going with this. Yep. When we hear from him in 45 minutes' time, he needs to hit the ground running. We know what they want to do on COVID restrictions. Where do you think we're heading on the fiscal side?
Well, at the moment, the indications are, and we saw a letter published, an article published by Boris Johnson and his Chancellor of the Exchequer, Rishi Sunak, recently, talking about the fact that they were going to stick with, in particular, the national insurance hikes that are coming through. But that is certainly an area that people have been talking about as an area that they could have some degree of wiggle room on, particularly given the cost of living crisis that is coming towards the UK, John, with high gas prices, with high prices. We've seen what the inflation numbers are recently. That will be an area that maybe they will focus on. But at the moment, it seems to be a show of strength that they are going to raise those taxes. But that, again, is not something that traditionally sits with the Conservative Party. So I think it's going to be interesting, as you say, to see what he says. But at the moment, the market is anticipating that we're going to have a seriously strong inflationary push in the UK. The Bank of England is going to raise 5 times. Does that sit side by side with a fiscal push as well?
Just
Big
look
experiment.
at how perfect Guy's tie knot is. And he's done that in a couple of minutes without a mirror. Guy, looking forward to the show.
The good news is that I've also got trousers on.
I hope so too. Let's not test that and find out. Guy, thank you, buddy. Looking forward to the show in about 20 minutes. Let's talk about the data out of China too and get to Damien Sassower of Bloomberg Intelligence. Damien, how much are we slowing here?
Yeah, we're still slowing, Jonathan. I mean, look, both the manufacturing and the non-manufacturing PMIs were down in China. And in fact, the caption, which focuses on small businesses, as you know, slipped into contractionary territory. So what does this mean? Small businesses are hurting. The economy failed to pick up in the first month of this year. And here we go into the Lunar New Year with both the both price gauges, both the output and input price gauges within the PMI rebounding after falling the last 2 months. What that means, my goodness, you're going to see inflation start to tick higher again in China. You're going to see PPI rebound a little bit here potentially. And what does that mean for inflationary dynamics abroad in the rest of the emerging market space and more specifically here in the U.S.?
Damien, just a final word. I mentioned this with TK a little bit earlier this morning. NFL overtime rules. Why can't they just use the college overtime rules? What's that about, Damien?
Don't get me started. I think it was about television. They tried to shorten up the games once upon a long time ago, Jonathan. They did a really, really poor job of it. I mean, those overtime rules need to be overhauled completely. But let's talk about Rafa, huh? I mean,
yes.
What a match that was. That was awesome. With all the great football, don't get me wrong. What an awesome Australian. I mean, what a win.
I get anxious watching Rafa, so I only tuned in for the 5th set because I'm such a big Rafa fan. That was just beautiful. Damien, thank you, sir. We appreciate it. Damien Sassower there on a situation in China. Let's get to the data as well. We can do that with Mike McKee. Mike McKee, payrolls and a little bit of a tease this morning too. What are you looking at?
Well, for the markets, it's always, what are you going to do for me next? And we get some contemporary numbers this week. Jobs, of course, going to be leading the pack, but there's some other really interesting things coming out. ISM tomorrow as manufacturing slowing down, and JOLTS. We don't often get the JOLTS numbers in the same week as the payroll numbers. This will tell us something about demand for labor in December. Did it slow down? And then on Thursday, ISM services. Everybody's worried about the service industries. How do they do in January with Omicron running around? We'll find out. The jobs report, as we mentioned, the key for the week, and there is such a wide dispersion in numbers from plus 250,000 to negative 400,000. Now, the 250,000 is still very low, and the feeling is companies just stopped hiring during the month of January because of Omicron. And earlier you mentioned on the show, we have the hearings for the Fed nominees this week. A lot of it's going to be about bank regulation and whether or not Sarah Bloom Raskin meets standards there. Even if they do get through these hearings okay, they probably won't be on the Fed until mid-year at the earliest. So while it'll be interesting to watch, it won't be as important to those who are trying to make interest rate bets than the rest of the data we get this week.
Mike McKee, just reading through the resumes and some of the pieces that have been written on, say, Philip Jefferson and Lisa Kirk, they just look like fantastic candidates that are going to get support from both sides in many ways, both Republicans and Democrats. Sarah Bloom Raskin is where there might be a little bit more controversy here, Mike. How difficult do you think it will be to get her through this confirmation process?
If this were a couple of years ago, it might have been easier. Now it's going to be really hard because the two sides, the Republicans and Democrats, are so divided that a lot of Republicans will vote against her no matter what she says. The Democrats have to get her to say that she will not go outside the Fed's mandate in making regulations for the financial services industry. They can get her confirmed if they all stick together.
Mike, just final one from me. Do you think the Fed ignores that payroll sprint on Friday? Is there anything that we can take from it? When we cover that on Friday, and you've seen that range already, you mentioned it, 150 is the median, I think 250 is the high, negative 400K is the low. How are people going to interpret that? Just ignore it, focus on wages? Do wages tell you anything at all? What's in it that's worth looking at?
Well, the Fed has expected an Omicron impact, so they will look at it to see how bad it might be, but they're going to look at more contemporary data as February goes on, and we'll have the February payrolls report before we get the next Fed decision. So we'll see if it was just a one-time drop, if indeed that's the number we get, or whether it presages weaker economy going forward.
Mike McKee, thank you, sir. Our economics editor on top of the policy story for us as well. Just ahead of payrolls, think about how much we're baking in to the front end. Are we really going to look through another soft print on payrolls if it comes in, say, in negative territory? Bank of America thinks so. They're at negative 150K, and they still think that we'll get 7 hikes this year. A lot of people have put that down to Omicron and hopefully move on. The consumer sentiment numbers, does that make you nervous, or can we move on from that too? These are things we need to talk about in the week ahead as we work our way through to payrolls Friday. Yields are higher on 2s by 3 or 4 basis points, just short of 120 at the moment. Just about 180 on 10s at the moment, up 3 basis points there too. Coming up, your trading diary from New York City. What a week ahead we've got for you as we look to sprint away from the month of January and leave it behind. From New York, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
"25 minutes into this one, let's whip through it for you. The final trading day of January. I'm out of breath, you're exhausted too. We're up 0.25% on the S&P, trimming the monthly loss to around about 7%. The monthly loss on the NASDAQ 100 so far at least, in and around 10% lower. Right now, equities higher across the board, with the NASDAQ outperforming up by 1.3. That's the equity story. Here's the bond market. Just briefly on 2s, added so much weight into the front end of the curve, up another 4 basis points to 120. That's the level we're sitting at the moment, in and around 120, a move of 45 to 50 basis points, somewhere in between. Year to date, in just a single month. Unreal stuff. That's the price action. Let's get to the trading diary. What you need to be looking for. San Francisco Fed President Mary Daly leading the Fed speak at 11:30 Eastern. I need a rest. ISM manufacturing numbers coming on Tuesday, plus we get earnings from Alphabet. ADP figures coming on Wednesday, then Facebook reports after the close, followed by Amazon on Thursday, and finally, rounding out the week with the US payrolls report from New York. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
variant and the latest wave have an impact on not only consumer trends, but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
He has a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the wellerman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencers.